Please like, share, and subscribe. Wishing you happiness and good luck every day.
Today, we're going to talk about a modern investing strategy that basically throws the old rulebook right out the window. It's an approach that's backed by a ton of data, and it's designed to do two things: get you better returns, but with a whole lot less risk. So let's dive in. You know, if you're a long-term investor, there's one thing that probably keeps you up at night. And that's the fear of a massive market crash wiping out years of your hard work, usually right when you can least afford it. It's the number one reason people just fail to reach their financial goals.
And that really makes you stop and ask yourself a tough question. Is my entire retirement, my whole financial future, strapped to a strategy that's proven to be this volatile? For millions of us, the answer is kind of scarily yes.
Okay, now take a look at this, because this is where it gets real. This chart shows what happened if you followed the most common advice out there. Just buy and hold an S&P 500 index fund. If you started in March of 2000, you'd have watched your money get cut in half. Then, after years of clawing its way back, it happened again, dropping almost 60%. Get this. For 13 and a half years, you would have made zero real gain. Zilch. Now that gut-wrenching drop from the peak, that has a name. It's called a drawdown. And it's not just some abstract number on a chart. It is the real physical pain you feel watching your savings just disappear. Honestly, managing this risk is the single most important job an investor has. And don't think that was a one-off event. It wasn't. When you look back over the last century, these huge crashes where you lose 40, 50, even 60% of your money, they're not an anomaly. They're a regular feature. They happen about every 18 years on average. Think about what that means. The strategy we're all taught to follow almost guarantees that we'll get completely wiped out, probably multiple times over our investing lifetimes. So why? Why does this keep happening? Well, to get to the bottom of it, we've got to look at these old school strategies that have somehow become common knowledge. People call them lazy portfolios, and honestly, their biggest weakness is right there in the name. A lazy portfolio is just static. It's a fixed recipe. You know the one. 60% stocks, 40% bonds. You set it up, and then you're told to just forget about it. The problem is, the market doesn't forget. The market is dynamic. It's always changing, and sometimes it gets really ugly. But the lazy portfolio, it just sits there and takes the punch every single time. And this isn't some theoretical problem. This static approach has failed investors, spectacularly. In just the first decade of the century, these lazy strategies led people to lose between 35 and 50% of their money. And not just once, but twice. That's not bad luck. That's a bad design. And this is where our own brains start working against us. Academics have found something they call the behavioral pain point. And what it means is, for most human beings, when their portfolio drops by about 25%, the emotional pain just becomes too much to handle. Our survival instinct kicks in, we panic, and we sell everything, locking in those huge losses right at the very bottom. These lazy portfolios are designed to push you right past that breaking point. But, and this is a big but, here's the good news. While all these old strategies were failing us, there was a quiet revolution going on in the background, one that completely changed what's possible for a regular individual investor. It wasn't just one single thing. It was this perfect storm, a convergence of three massive trends: in technology, in finance, and in academic research. And together, they created what you could call the index investing revolution. So what were they? First, trading costs completely collapsed. What used to cost you a fortune is now basically free. Then came the exchange-traded fund, the ETF. This was a total game changer, giving everyone access to entire markets for super low fees. And the third one, this is the real secret sauce. Academics finally proved the existence of a powerful market force called momentum. So what on earth is the momentum factor? It actually sounds way more complicated than it is. It's simple. Hundreds of studies have proven that things that have been going up for the last 3 to 12 months, well, they tend to keep going up for the next month or so. It's kind of like market inertia. Winners tend to keep on winning. And hey, you don't have to take my word for it. Eugene Fama, this is a guy who literally won the Nobel Prize in economics for his work on market efficiency. Even he called momentum the premier anomaly. He's basically saying that out of everything they've studied, this is the most powerful, most persistent factor for predicting future returns. I mean, that's a huge deal.
So the big question is, how do we take this revolution, the low costs, the easy-to-use ETFs, and this incredible momentum factor, and use it to solve that investor pain point we talked about? Well, the answer is a whole new approach called muscular portfolios.
A muscular portfolio is the exact opposite of a lazy one. It's adaptive. It moves. But active here doesn't mean you're sitting around guessing what to do. No way. It's a 100% mechanical, rules-based system that simply follows the momentum factor to stay in the strongest parts of the market, and, maybe even more importantly, to get out of the weak ones. And the results? Well, they speak for themselves. Just look at this 43-year chart. See the orange line? That's the S&P 500 roller coaster with those terrifying drops. Now look at the green and blue lines. Those are muscular portfolios. They deliver fantastic returns, even better than the S&P. But look at the losses. During the dot-com bust, they barely broke a sweat. In the 2008 financial crisis, their losses were small, and they stayed way above that 25% panic point. It's a completely different world. Let's just put it head-to-head. Maximum loss? Over 50% for the buy and hope strategy. With a muscular portfolio, you're keeping it under 25%. Annual returns, significantly higher for the muscular portfolios over the long haul. The approach? Adaptive, not static. And the time it takes? That's the best part. Because this is the kicker. You might be thinking this sounds complicated, like it's a second job. It's not. It's not day trading. It's not staring at charts all day. Because it's just a simple rules-based process. It takes about 15 minutes once a month to check the signals and make a trade if you need to. That's it. 15 minutes a month.
And this all leads to a really powerful idea. With these new tools and this new science, you don't have to pay expensive advisors who are probably just going to stick you in one of those old, failing strategies anyway. You can actually become your own and your best financial advisor. And I'm serious about this. This isn't rocket science. The actual mechanics of doing this are incredibly simple. If you have ever used a website to buy a plane ticket or order something online, you already have all the technical skills you need. Period. It really just boils down to 3 core principles. Number 1, you aim for stock-like returns, or even better, over the long term. Number 2, you do it by making small, disciplined changes, just once a month or even less. And number 3, this is the most important one, you systematically keep your losses small, not by guessing, but by following a proven, evidence-based rule.
And all of that leaves us with one final question. When you really think about it, the old buy and hope method, it's not really investing, is it? It's more like gambling. Gambling that a crash won't hit right when you need the money. A muscular portfolio, on the other hand, is about systematically investing based on evidence. So are you ready to stop gambling and start investing?
All right, let's talk about investing. We're usually told there are only 2 choices, right? Go for big, scary risks to get big rewards, or play it super safe and get, well, almost nothing. But what if that's a false choice? What if there's a third way? A Goldilocks strategy that's not too hot, not too cold, but just right for actually growing your money without all the drama.
You know how a cat sees a little red laser dot? It just has to pounce. It's pure instinct. Well, here's the thing. We're not that different. You put a stock chart in front of us with those jagged lines jumping all over the place, and some deep, primal part of our brain just lights up. It screams, chase it. Chase those profits. But here's the problem. When it comes to investing, that very instinct is our own worst enemy.
So why is getting a handle on that instinct more critical right now than ever before? Because the whole game has changed. The world of saving for retirement, it's been completely turned on its head. All that responsibility for building a future, it's been taken from the pros and dropped right into your lap. You are in the driver's seat now.
I mean, just look at this timeline. It tells a wild story. Not that long ago, back in 1979, almost 40% of workers had a pension. A guaranteed check for life, managed by professionals. But that world is basically gone. Today, it's all about 401ks, which means you, and only you, are taking on all the risk of the market's crazy ups and downs. That safety net, it's been pulled right out from under us.
Okay, so if we're all in the driver's seat, are we, actually ready to drive? Let's do a super quick test. Just think about this for a second.
Let's say your savings account pays you 1% interest, but inflation, the cost of everything going up, is at 2%. After a year, is your money worth more, less, or the same?
The answer, of course, is that you can buy less. Your money is actually losing purchasing power. And hey, if that didn't click for you right away, you are in the vast majority. A stunning 70% of Americans couldn't get 3 simple questions just like this one right. And this knowledge gap, well, it creates a massive opening for the financial industry to sell us complicated, expensive stuff that might not be in our best interest at all.
So what's the first piece of advice pretty much everyone gets? You've heard it a million times. Just put your money in an S&P 500 index fund and forget about it. Buy and hold. It sounds so simple, so safe, like it's the gospel truth. But let's pull back the curtain and look at what that advice actually would have done to your money during a really tough time.
And this chart, wow, this is the harsh reality. If you followed that advice and invested at the peak in the year 2000, first, you would have watched half your money vanish in the dot-com bust. Then, after clawing your way back for years, you'd get slammed again by the 2008 crisis. At one point, you would have been down almost 60%, and get this, for 13.5 years, your money would have made zero, and I mean zero, real gains. Nothing.
That absolutely terrifying 60% drop, it has a technical name. It's called a drawdown. It's the official term for that journey from the highest peak of your portfolio down to its lowest valley. But really, it's just a clinical name for the pure financial and emotional agony you feel watching your life savings just evaporate.
And this is the real killer. Because as human beings, we have a limit to how much pain we can take. Study after study shows that once our losses hit around 25%, they call it the behavioral pain point, most people just cry uncle. They can't take it anymore. They sell everything at the bottom, which turns a temporary paper loss into a very permanent, very real one. This is how long-term wealth gets destroyed.
To really get this, we have to talk about 2 different kinds of returns. There's the nominal return, that's the flashy number you see on the news, but then there's the real return, and that's the only one that actually matters. It's what's left after inflation takes its slice. That painful S&P 500 chart we just saw, that was showing real returns. It was showing what happened to your actual ability to buy things.
Okay, so I know that was all a bit grim, but here's where the story does a complete 180. Because right around the same time all this responsibility was being shifted onto our shoulders, a quiet revolution was happening in the background. A revolution that gave regular people, for the first time ever, the tools to actually fight back.
It wasn't just one thing. It was this perfect storm of 3 huge trends. First, the cost of trading basically went to zero. It used to be super expensive. Second, these amazing things called exchange-traded funds, or ETFs, were born, giving us cheap and easy access to every market in the world. And third, and this is the big one, academics discovered something incredible, a powerful glitch in the market matrix.
And look, this wasn't some guy in a newsletter hyping a hot tip. We are talking about Nobel Prize-winning economists. Guys like Eugene Fama, who called momentum the premier anomaly in finance. He discovered that, against all odds, trends in the market often keep going.
So what exactly is this momentum factor? Well, it's actually pretty simple. Things that have been going up in price for the last few months, say 3 to 12 months, have a statistically proven tendency to keep going up. It's a way to ride your winners and, maybe even more importantly, a way to know when to get out of things that are starting to fall.
So, this is where it all comes together. When you combine these 3 megatrends, the super low costs, the incredibly diverse ETFs, and this academically proven momentum factor, you can build a completely new type of portfolio. One that is, well, just right. So I'll ask again, what if you could actually capture that amazing long-term growth the market offers, but without those terrifying gut-wrenching crashes that make people sell at the absolute worst time? Well, it turns out there's a way. And this is what it looks like.
And here it is. This chart is really the star of the show. That orange line is the S&P 500, with those massive dives we saw earlier. But look at the blue and green lines. Those are examples of muscular portfolios. You can see they ended up with fantastic returns, right up there with the S&P 500. But the crashes, look at them. Those huge wealth-destroying drops are just smoothed out. They're dramatically smaller.
Let's just zoom in on the 2008 financial crisis, the worst one most of us have ever lived through. Look at the numbers side by side. The S&P 500 got cut in half. a 51% loss. A muscular portfolio, like the Papa Bear version here, only dropped about 21%. That is huge. It stayed above that critical 25% pain point, which makes it so much easier to stick with the plan. And because it avoided that massive hit, its long-term gains were actually much, much higher.
So, to put it in a nutshell, what is a muscular portfolio? It's a system. It's not about guessing or having a crystal ball. It uses a simple, evidence-based rule. Once a month, you check to see what's trending up, and you move your money into a handful of those winning ETFs. The goal is simple: own what's strong, ditch what's weak, and protect your hard-earned money from those catastrophic market crashes.
Okay, I know what you might be thinking. If this is so simple and so effective, why isn't every hedge fund on Wall Street doing it? Won't this advantage just get competed away? And the answer is probably not. Because you, as a regular individual investor, actually have a huge advantage that the big guys just don't.
There are really 3 big reasons. First, this strategy forces you to fight your own human nature, that instinct to chase things when they're hot and panic when they're not. Second, and this is a funny one, it's just too simple. You can't charge a billionaire 2% a year for a strategy they could do themselves in 15 minutes a month. And third, the giant pension funds and institutions, they're like giant cruise ships. They're just too big and too slow to turn this quickly.
This cartoon just says it all, doesn't it? The whole business model of Wall Street is built on selling complexity, on selling you a secret sauce that only they have. A simple, elegant strategy that actually works and that anyone can do is a direct threat to that model. They have to sound smarter than you to justify those massive fees.
And this grid really wraps it all up nicely. You've got your lazy portfolios that kind of lag behind and still get crushed in crashes. You have high-risk strategies that are, well, they're a roller coaster. Everyone dreams of finding the Yeti, the strategy that beats the market all the time with no risk, but it's a myth. Muscular portfolios sit in that sweet spot of reality. They offer real protection when markets turn ugly, and that is the key to getting better results over the long run.
So really, it all comes down to this. As an individual investor, your small size is your greatest strength. You have the flexibility and the nimbleness to use a simple, powerful, evidence-based strategy that the giants of Wall Street literally can't touch. You don't have to play their game. So the only question left is, are you ready to start using that advantage?
What if I told you that the secret to long-term investing success isn't what you think it is? It's not about finding that one stock that's going to shoot to the moon. Actually, it's pretty much the opposite. It's this fascinating paradox. To really win, you have to get incredibly good at not losing. All right, to kick things off, let's start with a little quiz about, maybe the most famous investor of all time, Warren Buffett. When the market was red hot during those huge bull markets, how did he actually stack up against the S&P 500? Take a guess. Okay, so here's the data, and this is where it gets super interesting. You can see his overall performance, that blue line, is way, way better over the long haul. But I want you to look really closely at the parts labeled bull market. See what's happening there? When the market's soaring, the orange line is actually pulling away from the blue one. And yep, the answer is C. He underperformed. It's kind of shocking, right? During those massive run-ups, his portfolio gained only about 2/3 as much as the overall market. So, wait a minute. If he's lagging when things are great, how on earth did he end up so far ahead of everyone else? Well, his secret is something we'll call the Buffett buffer. It's simple, really. When the market crashed, he just lost a whole lot less money. Think about the dot-com bust or the 2008 crisis. While the S&P was getting cut in half, Buffett's portfolio just had smaller dents. His entire game is built around playing incredible defense. And let me tell you, this defensive approach adds up to some serious money. Over that 15-year roller coaster, $100,000 in the S&P 500 would have grown to about $128,000. Not bad, but that same $100,000 with Buffett, it would have turned into $269,000. That huge gap wasn't built on offense. It was all defense. Okay, so let's get into the why. Why is playing defense so incredibly powerful? Well, it all comes down to the simple and kind of brutal math of losing money.
The concept you absolutely have to understand is recovery time. See, when you lose money, you're not just losing value, you're losing time. It's like digging a hole. The deeper you dig, the exponentially harder and longer it takes to climb back out to ground level.
And wow, this chart just lays it all out, doesn't it? Take two portfolios. Let's say they both grow at the same rate after a crash. The one that only lost 25% gets back to even in about 4.5 years. But the one that lost 50%, it takes a staggering 11 years just to get back to where it started. That's a whole decade of your life with zero growth.
And here's the unforgiving part. The math isn't symmetrical. If your portfolio gets cut in half, a 50% loss, you don't need a 50% gain to get back. No, you need a 100% gain. You have to double your money. But if you only lose 25%, you just need a 33% gain. You see, avoiding that big loss is everything. Let's just imagine a simple, conservative portfolio. It's designed to only capture 2/3 of the market's gains. But, and this is the magic part, it only suffers half of the market's losses. Just by following that one simple defensive rule, over 15 years, it would have almost doubled the return of the S&P 500.
Okay, that makes sense. Defense is key. So how do we find a good defensive strategy? The obvious move is to look at track records, right? Find someone who's done well recently. Well, I'm here to tell you that is a huge, huge trap.
So, some fascinating research found this really weird, lopsided truth about performance. If a strategy is a top performer over 1, 5, or even 10 years, its chances of being a top performer in the future are basically a coin flip. It's random. But a strategy that performs badly, it is very likely to keep on performing badly. In other words, short-term success is random, but failure is predictable.
So how long of a good track record do you need for it to actually mean something? The research suggests you need to see at least 15 years of top performance before it even becomes slightly predictive of future success. You know those 3- and 5-year track records that funds love to brag about? Statistically speaking, they're completely meaningless. And this isn't just a trap for us regular folks. Even the big institutions fall for it. This one study is just incredible. It found that institutions would routinely fire their money managers for having a few bad years. And the crazy part? The managers they fired ended up outperforming the brand new shiny managers they hired to replace them. They were chasing short-term noise, and it cost them. All right, so if chasing hot performance is a bad idea, what about the most common advice for playing it safe? You've heard it a million times. Diversify. Just build a so-called lazy portfolio.
Yeah, you know the drill. These are the classic set-it-and-forget-it deals. You buy a little bit of everything, U.S. stocks, international stocks, bonds, real estate, and then you just sit back and relax. The goal is to smooth out the ride. But there are two massive, glaring problems with this whole approach. Problem number one is pretty simple. They just don't perform that well. You can see it right here in the data. Over 3 years, 5 years, 10 years, 15 years, it doesn't matter. Every single one of these popular lazy portfolios underperformed the basic S&P 500. So right off the bat, you're giving up growth. But here's the real kicker. Here's problem number two, the real trap. You give up the gains in the good times, but they completely fail to do their one job, protect you in the bad times. During the 2008 financial crisis, these supposedly safe, diversified portfolios still got crushed, losing between 36 and 49%. That is a catastrophic, life-changing loss. And if you're wondering why, well, this slide tells the whole story. Because when a real crisis hits, everything that looks and feels like a stock falls off a cliff at the same time. U.S. stocks, international stocks, small companies, real estate, they all go down together. Simple diversification isn't a life raft. It's just tying a bunch of sinking boats together. Okay, so where does that leave us? It brings us to a really crucial shift in mindset. We need to move away from being passive and lazy and towards something more active, something we can call a muscular strategy. The difference is really night and day. A lazy strategy is static. It just holds on tight and hopes the storm passes. A muscular strategy is adaptive. It's built to react. It has rules that tell it when to get out of assets that are sinking and when to move into things that are safer, like cash or bonds. And the number one goal of a muscular strategy is to avoid crossing this critical threshold, a 25% loss. Because all the research shows this is the behavioral pain point. It's where normal people can't take it anymore. They panic, they sell at the absolute bottom, and they lock in those devastating losses forever. And look, this isn't just some theory. This is the new reality. As Mohammed El-Arian, the former head of PIMCO, one of the biggest investment firms in the world, said, the old rules don't work anymore. Just diversifying isn't enough. You need something more.
So this all boils down to one final critical question that you have to ask yourself about your own investments. It's not, how much can I make when things are good? The real question is, how much am I protected when things go terribly wrong? Because as we've seen today, surviving the bear markets isn't just a part of the game, it's how you actually win.
You know, every single investor runs into the same classic problem. You're looking for a strategy that's not too risky, but also not so conservative that it barely grows. It's the Goldilocks problem of finance, right? How do you find the one that's just right? Well, today we're going to walk through a framework that's designed to do exactly that.
I love this quote because it perfectly captures what we're trying to do here. We're not going to get lost in 1,000 different complicated theories or a bunch of jargon. Instead, we're going to follow a really clear, simple path to find that perfect fit so you can stop wondering and actually put a plan into action.
So, how are we going to do it? Well, it all comes down to a personalized roadmap that's built from just 4 key questions. That's it, just 4. Think of this as your own personal guided journey to an investment strategy that actually matches your real-life situation.
And here it is. This is our map for the journey. This simple decision tree is the tool we're going to use. You just start right at the top, answer a few questions as we go, and boom, you'll land on the ideal strategy for you. So let's walk through it together right now. Okay, let's start with the very first fork in the road. It's a really straightforward question. It's all about the size of your portfolio. Do you have more than $5 million to invest? Just a simple yes or no. So, if you answered yes to that, your journey on this map is actually complete. Your path leads straight to the endgame portfolio. It's a strategy designed specifically for wealth preservation. Think more about income and stability. Now, for everyone else who answered no, let's keep going down the path to our next question. All right, so for all of you with less than $5 million, here's question number 2. Do you have less than $10,000 to invest? Again, just a simple yes or no is all we need. If your answer here is yes, that's fantastic. The decision tree points you directly to the baby bear portfolio. It's a really simple and effective way to get started. It's designed to grow kind of like the S&P 500, but, and this is the key part, it has features built in to help cushion the blow during market downturns. Now, if you answered no, which means you have between $10,000 and $5 million, our next questions are going to get a little more personal. They're all about risk.
Okay, this is a real gut check moment. I want you to really imagine a nasty bear market. Could you look at your account statement, see that it's dropped by a full quarter, 25%, and still stick to your plan without totally freaking out and selling everything? Be honest with yourself here.
If you said yes to that, if you can stomach that kind of volatility, then you have a higher tolerance for risk. That means the Papa Bear portfolio is likely your best fit. By being okay with bigger swings, you also open up the potential for greater gains in the long run. Now, for those of you who said no way to that, we've got one final question.
All right, let's dial back the risk just a little. So a 25% drop was too much to stomach. But what about an 18% decline? Could you handle that kind of temporary loss in a bad market? This is the final fork in our road. Okay, so if you can handle an 18% drop, then the Mama Bear portfolio is your just right fit. But if the answer is still no, if even an 18% decline sounds too stressful, your path also leads you to the endgame portfolio, which you'll remember prioritizes stability above all else. And just like that, you've found your recommended strategy. So now what? Let's take a closer look at what each of these actually means.
Now that everyone has landed on a recommendation, let's get properly introduced to the Bear family of portfolios so you can see exactly how they stack up against each other.
This table breaks it all down nice and simple. You've got the baby bear, perfect for starters, and check this out, it only needs a yearly check-in. Super easy. Then you have Mama Bear and Papa Bear, and both of those just need a quick 15-minute checkup once a month. The endgame portfolio is a bit different because it's focused on preservation. But for most folks, the big takeaway here is how little effort we're talking about. So I keep saying 15-minute monthly checkup, but what does that actually look like? Let's be really clear. This is not about spending hours and hours researching stocks. No way. This is about a quick, simple tune-up to keep your portfolio on track, because the system itself does all the heavy lifting for you.
It all happens right here on the muscularportfolios.com website. And get this, it is completely free. You don't even need to give them an email address. You just go to the site, and it gives you the updated ETF rankings for your portfolio, and you can see it on any device. As you can tell, it's just a clean, simple table with the top-ranked funds. No fluff.
So your monthly routine is just these 3 steps. 1, you visit the website. 2, you look at the top-ranked funds for your portfolio to see if they've changed. And 3, if they have, you just make your trades before the market closes. That's it. That is your 15-minute tune-up, once a month.
Now, to make sure that super simple process goes smoothly, there are just a few really important rules of the road to follow. Think of these tips as your safety net, designed to protect you from some common pitfalls so you can trade safely and effectively.
I want you to remember this number, 1%. This is a critical safety switch that can protect your money during a very rare but chaotic market event that's called a flash crash.
So this number refers to something called the bid-ask spread. All that is the tiny price difference between what people are buying and selling a fund for. If you ever log on and see that this gap is greater than 1%, just stop. Do not trade. It's just a sign that the market is acting a little crazy for a moment. Wait an hour, check again, and only make your trade when that spread is back to normal, which is usually way under 0.5%.
And here are a few more must-know rules. Always trade when the U.S. market is open, so between 9:30 a.m. and 4 p.m. Eastern Time. Never, ever place a market order after hours, because you can get a really bad price when the market opens the next day. And hey, if your job makes it tough to trade during those hours, just look for a broker that offers something called window trades. It lets you set up your trade at night for safe execution the next day.
Finally, it's really important to know what this tool is for. Muscular Portfolios is a powerful, do-it-yourself strategy specifically for growing your savings. But if your financial life is more complex, you're dealing with wills, trusts, a family business, that kind of stuff, that's when you should absolutely seek out personalized advice from a professional, fee-only advisor. And that brings us right back to the beginning. We've walked the path together, we've explored the options, we've learned the rules of the road. So now, the only question left is the one you see right here. After going through our 4 questions, which portfolio is the just right fit for you?
All right, let's talk about an investment strategy that's a real game changer. It's called the Mama Bear Portfolio, and it's designed to be super simple, really powerful, and most importantly, to protect your hard-earned money when the market goes crazy. Let's dive in.
You know that feeling, right? That pit in your stomach when you've been investing for years, doing everything right, and then bam! A market crash comes along and just vaporizes a huge chunk of your portfolio. It's probably the biggest fear we all have as investors. Okay, now just look at this chart. The difference is staggering. That orange line, the standard S&P 500, got cut in half in the worst downturns, a 51% loss. But the green line, the Mama Bear strategy, its biggest drop was only 18%. That is a world of difference. It's the kind of performance that lets you actually sleep at night.
And this really gets to the heart of the problem for all of us, doesn't it? We want our money to grow, of course we do. But we're also terrified of those huge, gut-wrenching losses. The classic buy-and-hold approach has worked over the long run, sure, but it comes with these absolutely brutal portfolio-crushing drawdowns.
So this is where the Mama Bear portfolio steps in. Think of it as the just right solution to that dilemma. It's not too hot, not too cold. It's a simple and really effective way to aim for better returns than the market, but with way less of that scary volatility. So who is this for? Well, it's really for everyday investors, not for Wall Street day traders. We're talking about a system that takes just 15 minutes a month. You work from a simple, fixed menu of only 9 ETFs, and the goal? To keep those big losses in check, down around 18%, while still aiming to beat the S&P 500.
And I really want to let that sink in. 15 minutes a month. That's it. This whole strategy is about making your money work smarter for you so you don't have to work harder at it.
So how does it actually do this? It's not magic, I promise. It's all based on a really solid data-backed idea and just 3 simple rules. Let's pop the hood and see what makes the Mama Bear run.
The engine behind this whole thing is a concept called momentum. And all it really means is that things that have been winning tend to keep on winning, at least for a while. It's like a hot streak in sports. So what this strategy does is it looks at the funds on its menu, and each month it just ranks them based on their performance over the last 5 months to see who's on a hot streak.
And this right here, this is the entire universe you'll be playing in. This is the menu. Just 9 different ETFs that give you exposure to pretty much everything. Stocks, bonds, gold, you name it. For this strategy, these are the only 9 investments you ever have to think about. That's it.
Now, this is a really important distinction to get. The menu is that fixed list of 9 funds we just saw.
But your actual portfolio, the stuff you actually own, is only the top 3 performers from that menu each month. You're not buying all 9. You're just holding the 3 that are currently leading the pack.
So what did those 15 minutes a month actually look like? It's this simple. Step 1. On whatever day you choose, you go to a free website that does all the ranking for you. Step 2. You just look at the list and see which 3 ETFs are on top. Step 3. If you own anything that's dropped out of the top 3, you sell it. And step 4. You use that money to buy whatever is new in the top 3. You're done. That's the entire tune-up.
Okay, so you might be thinking, why 3? If this whole thing is about picking the winners, why wouldn't we just put all our money in the #1 top-ranked ETF each month? It's a really good question.
I mean, it sounds like the ultimate power move, right? Just find the absolute strongest horse in the race and bet everything on it. Go for the glory. But, as it turns out, the data tells a very different and much more interesting story.
And this chart says it all. See that crazy jagged red line? That's what happens when you hold only the #1 ETF. It's a roller coaster. Now look at that much smoother green line. That's the portfolio holding the top 3. It's a much gentler ride, and here's the kicker. It actually ends up higher in the long run. And the numbers make it crystal clear. The top 3 portfolio gave you almost 12% a year, while the top 1 portfolio only gave you about 9%. But even more important is that max drawdown. A 13% loss versus a 30% loss. I mean, which one would you rather live through? It's a no-brainer. Never put all your eggs in one basket, even if it's the hottest basket right now.
And you should know, this isn't just some theory someone cooked up in their basement. This whole approach is a clone of a strategy from Steve LeCompte over at CXO Advisory. This is a guy who's famous for sifting through thousands and thousands of academic papers and market guru predictions just to figure out what actually works versus what's just noise. This is built on a mountain of data.
Okay, so before we finish up, let's go over a few super important don'ts. Think of these as the simple rules of the road that are going to keep you on track and make sure this strategy works the way it's supposed to.
First up, don't try to get fancy and add your own favorite ETFs to the menu. I know, it's really tempting to think you can tweak it and make it even better. But trust me, it's been tested to death, and adding other funds almost always ends up hurting your performance or just adding risk you don't need. These 9 are optimized to work together. Second, do not use mutual funds instead of ETFs. For this to work, you need to be able to trade instantly, like you do at a stock. Mutual funds only get priced once a day at the very end. That delay means you're acting on old news, which can totally throw off your timing and hurt your returns. Plus, the fees are usually higher. Stick to ETFs.
And finally, don't use old data. Momentum is all about what's happening right now. The best way to do this is to check the rankings and make your trades all in one go on the same day. Waiting even a day or two can start to eat away at your results. So stay on top of it.
And I just love this little rhyme from the source material. It really sums up the whole philosophy, doesn't it? The magic here is in its focus and simplicity. You ignore the noise from thousands of other options, you focus on just these 9, and you let a simple process do the heavy lifting for you.
So that really just leaves one last question for you to think about. For just 15 minutes of your time every month, you get a data-proven method for potentially higher returns with way, way less risk. So what could you achieve with that?
Hey everyone, and welcome. You know, in a world where the market seems to jump around every single day, we're all looking for an investment strategy that's not just profitable, but tough, really robust. So today, we're going to dig into one of those strategies, one that was specifically designed to handle the chaos and hopefully come out ahead.
Okay, so let's just dive right in. I want you to picture the 2008 financial crisis. Utter chaos, right? The S&P 500, the thing that's in pretty much everyone's retirement account, lost a staggering 51% of its value. Just got cut in half. It was absolutely terrifying for millions of people. But get this, at the exact same time, there was another strategy out there that weathered that same storm and only lost 7%. So how is that even possible? Well, that's the big question we're going to answer.
And the answer is a strategy that's since been nicknamed the Papa Bear Portfolio. It's designed from the ground up to be strong, adaptable, and most importantly, super disciplined.
Now let's take a look at the long game, because that's what really matters. This chart here shows a 43-year journey, all the way from 1973 to 2015. So just imagine 2 people starting with the exact same amount of money. The person who just stuck with the S&P 500,
That's the orange line way down at the bottom. But the one who followed the Papa Bear strategy, yeah, that's the blue line soaring way up at the top. The difference is, well, it's pretty hard to ignore.
Let's put some real numbers to that growth. Over that same 43-year stretch, the Papa Bear portfolio delivered an average annual return of 16.2%, and the S&P 500, just 10%. Now that difference might not sound huge year to year, but when you let compounding do its thing over decades, it becomes absolutely massive. We're talking a game-changing amount of money. But you're probably thinking, okay, higher returns must mean way higher risk, right? And we measure that risk with something called maximum drawdown, which is really just a fancy way of saying the biggest drop your portfolio ever took from its highest point. Now, during the worst crashes on that chart, the Papa Bear did take a hit, about 25%. But compare that to the 51% drop the S&P 500 took. It's less than half. It's all about managing that downside.
So where did this thing even come from? Well, its reputation was literally forged in the fire of one of the worst financial crises in modern history.
The credit really goes to a researcher and wealth manager named Mebane Faber. He first published his research way back in a 2006 white paper. That's before the crash. He then made it more accessible in his book, The Ivy Portfolio, and later beefed up the strategy in 2013, creating the foundation for what we're looking at today.
So Faber's original model was called the IV5. It was a bit simpler, using just 5 different types of assets. And the incredible thing is, because he published it in 2006, this wasn't just some hypothetical backtest. No, this thing was put through the ultimate stress test in real time, as the entire global financial system was literally on the verge of collapse.
And this is what connects it all so perfectly. Over on the left, you see the IV5's incredible performance during the 2008 meltdown, down just 7% when the S&P was down 51%. That core DNA, that ability to protect on the downside, is exactly what evolved into the amazing long-term growth you see in the Papa Bear chart on the right. See, a strong defense can actually lead to a much more powerful offense.
Okay, so we've seen the pretty incredible results. Now it's time to lift the hood and see how this engine actually runs. And you might be surprised at how straightforward it really is.
It all starts with this menu right here, a list of 13 different global ETFs. Now, if you're not familiar, you can just think of an ETF as a basket of investments that you can buy or sell just like a single stock. And as you can see, these baskets cover pretty much everything. US stocks, international bonds, gold, real estate, you name it. This wide diversification is step 1.
So here's the key. How do you pick which ETFs to own? The whole strategy is built on a simple momentum rule. You don't try to guess what's going to happen next. You just look at what's been working recently. Every month, you check the average return for each of those 13 ETFs over the last 3, 6, and 12 months. And then you just buy and hold the top 3 performers. That's it. That's the rule. And maybe the best part of all is that actually doing this takes maybe 15 minutes a month. Seriously, you just pick a day, you can check the rankings online and see what the top 3 are. If you already own them, you do absolutely nothing. If the list has changed, you just sell the ones that fell off the list and buy the new leaders. It's a simple rinse and repeat process. But wait, there's one more little detail here that I think is the real secret sauce of the Papa Bear. It's a subtle but really powerful feature that automatically solves one of the oldest debates in investing.
And that debate is value versus growth. So value stocks are kind of like finding a great brand on the clearance rack. The company's assets are actually worth more than the stock price would suggest. Growth stocks are the opposite. You're paying a premium price because everyone has huge expectations for the future. And for years, one style will be popular and then they'll switch. It's a constant cycle.
So here's the brilliant part. By having separate ETFs for both value and growth right there in the menu, the Papa Bear portfolio doesn't make you guess which one is going to win. The momentum rule does all the heavy lifting for you. It just automatically rotates your money into whatever style is working right now, whether that's big value stocks, small growth stocks, or something else entirely. You just let the market's own momentum tell you where to put your money.
All right, so we've looked at the performance, we've broken down the rules. The last and most important question is a personal one. Does this strategy actually fit your personality as an investor?
Well, according to the research, this strategy is probably a great fit if you can say yes to 3 things. Number 1, you're actually willing to spend those 15 minutes every single month to do the tune-up. 2, you're looking for higher returns, and you understand that means you'll have more ups and downs than a basic index fund. And 3, and this is the big one, you have the guts to stick with the plan even when you look at your account and it's down 25%.
This quote from wealth manager Barry Ritholtz just nails it. A system based on rules is only as good as your ability to actually follow those rules, especially when every emotional bone in your body is screaming, "Sell, sell, sell!" Discipline, really, is everything.
So, there you have it. A strategy built on broad diversification and simple momentum, battle-tested in a crisis, and all driven by a clear set of rules. It requires a little bit of your time, but a whole lot of your discipline. And so the final question is one that only you can answer. Is this kind of hands-on, rules-based approach the right one for your financial journey?
Ever feel like investing is just too much? Too much stress? Too much guesswork? Well, today we're going to break down something called the Baby Bear Portfolio. It's an incredibly simple strategy that basically just needs an annual tune-up to keep your savings on track. Let's dive in. All right, let's start with a feeling that I think we all know, that knot in your stomach when you're trying to time the market, right? You're asking yourself, am I buying at the very top? Am I about to sell at the absolute bottom? It starts to feel less like a smart strategy and honestly, more like you're just at a casino. Yeah, this probably looks familiar to a lot of you. We've all been there. You see the market just soaring, you finally jump in, and for a little while you feel like a total genius. Then you see a little dip, and you think, oh, this is perfect, a buying opportunity. But let's be real, what's actually driving those decisions? Most of the time, it's pure emotion. It's not a cold, hard plan. So what if you could just get off this emotional roller coaster entirely? I mean, for good. What if there was a simpler, more stable way to do this? A strategy that actually lets you live your life instead of being glued to the daily swings of the stock market. Well, that's exactly where the Baby Bear Portfolio comes in. And honestly, it's a pretty elegant solution to this very common problem. There's this famous saying, you've probably heard it, often attributed to Einstein, make everything as simple as possible, but not simpler. And that really hits the nail on the head here. The Baby Bear Portfolio isn't about being lazy with your money. Nope. It's about being incredibly efficient and effective. So what is it? Here it is in a nutshell. The Baby Bear Portfolio holds just two things. That's it. The entire U.S. stock market and the entire U.S. bond market. And you just split them right down the middle, 50-50, simple as that. And building it is, well, it's about as easy as it gets. You literally only need two low-cost funds. You've got Vanguard's Total Stock Market ETF, that's VTI, and their Total Bond Market ETF, which is BND. That is the entire shopping list, the whole shebang. Now, just so we're clear, this isn't some new trendy idea that just popped up online. No way. It's actually inspired by an investing legend, Jack Bogle, the guy who founded Vanguard. He was a massive advocate for this exact kind of balanced, super low-cost approach, especially for regular, everyday investors. Okay, so how do you actually manage this thing? You might be thinking there's a catch, right? Well, you're probably going to be surprised by how little work this actually takes. Okay, the process is incredibly simple. You start by buying equal dollar amounts of both funds. Then, you just leave it alone for a whole year. Once a year, you pop the hood, take a look, and if one fund is more than 5% off its target, you just rebalance. You sell a little of the winner and buy a little of the loser to get back to that perfect 50-50 split. And that's it. That's your entire maintenance for the year. All right, so that's the how. Now for the really interesting part. How does this simple little portfolio hold up when things get, well, really, really bad? Let's take a look at how it actually performed during some of the biggest market crashes in recent history. Okay, let's go back to the 2007-2009 financial crisis, a really scary time. If your entire portfolio was just in an S&P 500 index fund, you would have watched it get cut pretty much in half. We're talking a staggering 51% drop from its peak. Ouch. Now, during that exact same period, the Baby Bear Portfolio's loss was only 29%. Now look, that's still a loss, for sure. It's a downturn. But that's the kind of drop that's way, way easier to stomach emotionally and a lot easier to recover from financially. And this chart, it really tells the whole story. If you look at it over a 43-year period, the Baby Bear Portfolio delivered almost the exact same returns as the S&P 500. But, and this is the huge but, the key difference is the journey. The Baby Bear gives you a much, much smoother ride. It's like a shock absorber that protects you from the absolute scariest drops in the market. So here's the really crucial takeaway. Its real superpower is behavioral. It's about psychology. By making those big market downturns less painful, it helps you do the one thing that's most important: stay invested. It stops you from panic selling at the bottom, which, let's be honest, is where so many investors go wrong. Okay, so who is this actually for? Is this super simple portfolio the right fit for you? Well, it's not for everybody, but for certain people, it is an absolutely perfect fit. This strategy is a really great fit for a few specific types of people. Maybe you're just starting out, you've got less than, say, $10,000 to invest, or you're just busy. You're a new parent, you're focused on your career, you just don't have time for monthly check-ins. It's also for anyone who just wants to keep things super simple, keep costs and effort extremely low, or who wants to avoid the stress of complicated financial decisions. And maybe the most surprising advocate for this kind of radical simplicity is someone you would expect to have the most ridiculously complex, perfectly optimized portfolio on the planet, a Nobel Prize winner in economics. Yeah, when Harry Markowitz, the guy who literally won a Nobel Prize for modern portfolio theory, was asked how he invested his own money, he gave this incredible answer. He said his intention was to minimize his future regret, so he just split his money 50-50 between stocks and bonds. He wasn't trying to squeeze out every last percentage point of return. He was trying to protect himself from the feeling of regret, no matter which way the market went. And that really leaves us with a final, powerful question, doesn't it? Could minimizing your own future regret actually be the smartest investment you ever make? Maybe the best strategy isn't the one with the most complex charts and the highest possible returns on paper. Maybe, just maybe, it's the one that lets you sleep soundly at night. All right, today we're tackling one of the most powerful and honestly most misunderstood forces in the entire world of finance. It's called compounding. This is something that can either work for you or, believe me, it can work against you. Understanding it is pretty much the key to building any kind of real wealth. So let's just dive right in. And this is not some new idea from Wall Street. We're talking over a century ago. The author Jack London called compound interest a remarkable invention. It's kind of like a force of nature in finance, and for generations, it's been the secret weapon for anyone who figures it out early. But here's why this really matters, right now. A report from the Economic Policy Institute a few years back dropped a pretty startling fact on us. Nearly half of all working-age families have absolutely nothing saved for retirement. I mean, zero. Zilch. That fact alone makes understanding compounding not just interesting, but, absolutely essential. Okay, so let's shift from the problem to the solution. How can we actually grab hold of this most powerful force and use it to build up that nest egg we all need? Let's break down how this thing really works. At its heart, compounding is actually pretty simple. It's just money making more money. Your first investment earns a return, right? But then that return, it starts earning its own return. It's like a chain reaction, this financial snowball that starts off tiny, but just gets bigger and bigger as it rolls downhill over time. To really, and I mean really, see this power in action, we're going to look at a story of two totally different savers. And let me tell you, the result of this showdown is one of the most surprising and frankly powerful examples of compounding you will ever see. So here's the question for you. Who comes out on top by age 70? Is it the teenager who invests a total of $35,000 between the ages of 14 and 20? Or is it the worker who starts later at age 30 but invests a much, much larger sum, $200,000 over a 40-year period? I mean, logic says the bigger number wins, right? Well, let's see about that. So this chart just flips everything we thought we knew on its head. Look at that blue line. That's our teen. They make just 7 deposits and then they stop. The orange line, that's the worker, who starts at 30 and saves consistently for 40 straight years. And yet, look what happens. The teen's early start gives them such a massive runway that their money just keeps growing. And eventually, it actually overtakes and leaves the worker in the dust. It's incredible. By the time they're 70, that teen's initial $35,000 has ballooned to over $1 million. And the worker? Well, despite investing nearly 6 times more cash, they end up with less, just under $950,000. That, right there, is the superpower of starting early. I know what you're thinking. How on earth is that possible? It sounds like it breaks the rules of math. But the answer isn't magic, though it's probably the next best thing. It's the magic of time. Let's break down these numbers. Okay, here's the side-by-side breakdown. The teen's money had 56 years to grow. The worker's money, even though it was a way bigger amount, only had 40 years. Get this, that extra 16 years of compounding for the teen was more powerful than an extra $165,000 in contributions from the worker. So it wasn't about the amount of money, it was all about the amount of time.
So this brings us to a really critical and maybe a little alarming takeaway. This isn't just some fun thought experiment. It has a direct impact on you, because every single day you wait to start investing, it has a cost. Let's see exactly what that cost looks like. This chart here illustrates the point perfectly. It shows you the percentage of a $50,000 salary you'd need to save to hit $1 million by age 70. Now, you really want to pay close attention to the pattern here because it's a huge warning sign. If you get started at age 20, you only need to save a pretty manageable 5.4% of your pay to become a millionaire. Totally doable, right? But if you wait just 1 decade, just 10 years, and start at 30, that required savings rate nearly doubles to 10.6%. The job just got twice as hard. And what if you wait until you're 40? It doubles again. You now have to save over 21% of your pay. The cost of putting it off is exponential. The longer you wait, the heavier the lift gets. Okay, I know that might sound a little intimidating, but the goal here is not to scare you. It's to empower you. Because once you know this, you can create a really clear, actionable path forward to make compounding your best friend on the journey to financial freedom. And what's the ultimate goal here? It's financial freedom. What's that? It's the moment your money is working so hard for you that you don't have to work for it anymore. It's that amazing point where your investments are generating enough income on their own that your job becomes, well, optional. You get to decide what you do with your time. So how do you actually get there? It really just comes down to 4 simple rules. 1, invest consistently. Put money into an account that grows. 2, this is key. Leave your gains in the account. Let them compound. 3, be smart about taxes. Use accounts like a 401k or an IRA. And number 4, just be patient. Let that snowball grow until it's actually bigger than your paycheck. And that really is the whole idea in a nutshell. Think about it like you're planting a tree. It starts as this tiny little seed, right? But with time and a little bit of care, it grows into something magnificent that provides shade for years and years. Your money can do the exact same thing, as long as you give it the single most important ingredient of all, time.
All right, let's get right into it. You've probably heard the old saying in investing, right? There's no such thing as a free lunch. Well, what if I told you there actually is one? Today, we are diving deep into diversification, a powerful and, honestly, kind of weird concept that can help you get higher returns with less risk.
So, let's put this in simple terms. Think of your investments like a plate of sandwiches. You could bet your entire lunch on just one, hoping it's the tastiest one ever made. But what if it's not? What if it's kind of soggy? Diversification is all about having different ingredients in your portfolio. You know, stocks, bonds, maybe some commodities, so that one bad ingredient doesn't ruin your entire financial meal.
And this quote from Ben Carlson, it just nails it. This isn't about chasing that one stock that's going to make you a millionaire overnight. That's a lottery ticket. No. This is about building a portfolio that can take a punch, weather the storms, and just keep growing steadily. It's about making sure you stay in the game long enough to win.
Now, to really see how powerful this is, we're going to start with a little quiz. It's a totally imaginary scenario, I'll admit, but it shows off the almost magical math that's going on behind the scenes.
Okay, so take a look. You've got 3 choices for your money. Which one do you think is going to come out on top? Just make a quick guess in your head before we reveal the answer.
So here are your options. Option A, put all your cash in a money fund that just chugs along, giving you a steady 1.2% a year. Boring, but safe. Option B, put it all into this other security that's super volatile. I mean, it bounces all over the place, but over the long run, its return is literally 0. It goes nowhere. Or C, you mix them, 50-50, and you rebalance every month. So what's your gut telling you? And the answer is C. I know, it's wild, right? By combining a slow and steady 1.2% asset with a bouncy asset that returns nothing, the portfolio cranked out an annual return of 5.4%. That's more than 4 times the safe option. You are literally creating growth from nothing but volatility. It's incredible. But, and this is a huge but, there's a catch. If you look closely at that chart again, you'll see that for the first 51 months, that's over 4 years, the smart diversified portfolio was actually losing to the boring old money fund. This isn't a get-rich-quick trick. It takes real discipline and patience to let this magic work over time.
Okay, that was weird enough, mixing a zero-return asset to boost performance. But let's push this even further. What if we try to build a portfolio where both of the assets are guaranteed long-term losers? I mean, can 2 wrongs possibly make a right here?
So, here's puzzle number 2. We've got 2 securities, C and D. Both are designed to lose you money over time. So which option do you think is, well, the least bad?
Let's be really clear about what we're looking at. Security C loses, on average, 11.4% per year. Security D is even worse, losing 12.8% a year. These are just genuinely bad investments. You can see they're random, jagged paths on the chart, and they both end up way down in the red.
And unbelievably, the answer is C. Again, by combining these 2 losing stocks in a 50-50 portfolio and just rebalancing it, the result wasn't a slightly smaller loss, it was a positive annual gain of 15.2%. This is absolutely mind-bending. You're holding nothing but 2 certified losers, and yet the portfolio is making money.
So how on earth is this even possible? Well, it all comes down to a principle called reversion to the average. It's the secret sauce in rebalancing, because the assets are just bouncing around randomly. One is usually up a bit while the other is down a bit. So every month, when you rebalance, you are automatically selling a little of the temporary winner and buying a little more of the temporary loser. You're systematically buying low and selling high without even thinking about it.
All right, these coin flip examples are cool for getting the idea, but does this stuff actually work in the real world with things you and I can actually buy? Let's find out. We're going to test it with 2 of the heavyweights, stocks using the S&P 500 and high-quality bonds.
So for our final quiz, let's look at this big 43-year stretch of history. Which strategy do you think won? Going all in on stocks, all in on bonds, or splitting it 50-50? So here's the setup. On its own, the S&P 500 was the champion of raw returns, hitting 10% a year. Bonds were a little behind at 8.9%. So it seems kind of obvious that 100% stocks is the winner, right?
Well, hold on, because the answer is way more interesting than that. Yeah, the S&P 500 did end up slightly ahead in the end, but the 50-50 Baby Bear portfolio, which returned 9.8%, was actually in the lead for 65% of all the months in those 43 years. You got almost the same return, but the journey was dramatically smoother and way less stressful.
And this right here, this is why it really matters. Look at the 2008 financial crisis. The all-stock portfolio got crushed, losing a catastrophic 51% of its value. That's the kind of drop that makes people panic and sell at the absolute worst time. But the 50-50 portfolio, it only dropped 29%. Now that's still not fun, but it's a loss you can psychologically survive, so you're still around for the recovery. That's the real power of diversification.
So what is the secret sauce here? What is the force that lets you combine a zero-return asset, or even 2 losers, and come out on top? The final piece of this whole puzzle is a little concept called correlation. And it's not as complicated as it sounds. Correlation is simply a measure of how 2 things move together. If 2 assets are highly correlated, when one goes up, the other goes up. When one goes down, the other goes down too. For this diversification magic to work, you need assets with low or even negative correlation. You want things that zig when your other stuff zags.
And this chart shows you exactly what that looks like. Up top, in the red zone, you've got other stock markets that pretty much just follow the S&P 500. They don't help much when things go bad. But look down here, in the yellow and green zones. Things like commodities, gold, and especially bonds, they often do their own thing, or even go up when stocks go down. They are the zig to your stock market's zag.
So, if a simple mix of 2 things can get you to 9.8% with way less risk, what happens when you really lean into this idea? On the right, you see a Papa Bear portfolio. This one is diversified across 13 different low-correlation asset classes. And the result? A 16.2% annual return. It blew both the simple mix and the S&P 500 out of the water. Now that is the free lunch in action.
Which really brings us to the final thought here. The evidence is pretty clear. Diversification is the one true free lunch in this game, giving you a shot at higher returns with less risk. So the question I'll leave you with is this. If that's the case, by sticking to just 1 or 2 things, Are you leaving money on the table by not ordering from the full menu?
You ever notice how winners just seem to keep on winning? Well, it turns out that's not just a saying for sports. It's a real powerful force in the financial markets. Today, we're going to break down momentum investing, a surprisingly simple idea that you can actually use.
So to get this, let's just rewind back to high school physics for a second. You remember Newton's law, right? An object in motion tends to stay in motion. Well, guess what? The same basic idea applies to your investments. Things that are going up, they have this funny habit of, well, continuing to go up.
All right, so physics is one thing, but how does this actually apply to our money, to finance? Let's nail down exactly what we mean when we talk about momentum in the markets.
It's actually pretty simple. All it is the observation that things that have done well recently, say over the last 3 to 12 months, have a tendency to keep doing well for the next month or even longer. You're just identifying and riding a wave that's already moving.
And look, this isn't some weird fringe theory from the internet. We're talking about Eugene Fama and Kenneth French. These guys are like the rock stars of finance, and they call momentum the premier anomaly. Now, when academics say anomaly, what they really mean is, holy cow, this thing shouldn't work according to our models, but it absolutely does.
Okay, so saying it works is easy, but what about the proof? Well, the evidence for momentum is frankly kind of staggering. Let's go way, way back. I mean, researchers went way back, 212 years, all the way back to the year 1800. Think about that. That's when there were like 10 stocks total in the entire US market. They crunched the numbers on over 2 centuries of data just to see if this thing was for real.
And the result? Over that entire 212-year stretch, the assets with the strongest momentum beat the ones with the weakest momentum by about 5% per year. That might not sound huge, but compounded over decades and centuries, that is a massive, game-changing difference.
So, what does this actually look like in practice? Take a look here. It's super simple. On the left, you've got a list of investments, ranked by how they've done lately. The ones in the green box, those are your winners, the top half. Now just fast forward 1 month, look at the right. A whole bunch of those same green guys are still in the top half. See? It's just that. Winners tend to keep on winning.
So this leads to a giant question, right? If this is so powerful, so well known, and has worked for so long, why is it still a thing? Why hasn't everyone jumped on this and made the advantage disappear?
I mean, really think about it. In what we call an efficient market, any free lunch like this should get eaten up instantly. So what makes momentum different?
Well, the answer isn't in some complicated financial formula. It's in our heads. It's human psychology. We're people. We do things like herding. We see something getting popular and going up in price, and we all want a piece of the action. And that very act of piling in just pushes the price up even more.
This graph here, it tells the whole story perfectly. It's the life cycle of a typical trend. So some good news hits, right? At first, the market is kind of slow to react. That's the underreaction phase. That's where a momentum strategy gets in. Then word gets out, the herd arrives. Everyone piles in, pushing the price way up, sometimes even past what it's really worth. That's the overreaction. The strategy just rides that wave of human emotion, from underreaction to overreaction. It's literally profiting from our collective tendency to be late to the party.
And you know, this whole psychological foundation is what makes momentum so special, especially when you compare it to other market-beating strategies or factors.
See, there's this really common pattern in finance. Some smart researcher discovers an edge, like, hey, small-cap stocks do better, or cheap value stocks do better. They publish a paper, it gets famous, and poof, the effect just fades away because now everyone knows about it and is trying to do it.
And this chart just says it all. It's brilliant. Look at the data. After the small cap effect was published, its extra return basically vanished. The value factor lost about 3/4 of its power, but momentum, look at that bar. It kept over 2/3 of its market-beating power. It is just incredibly stubborn.
It's this resilience that led financial advisor Gary Antonacci to say it's not just the best market anomaly, it might be the only one that's actually practical for regular folks to use. It just keeps working.
Okay, so let's put it all together. How does all this history and psychology translate into a real edge for you as an investor? What can you actually do with this?
The statistical edge boils down to this number, 54%. That's the chance that a top half performer this month will still be a top half performer next month. Now, I know what you might be thinking. 54%, that's barely better than a coin flip. But in a game of odds like investing, a consistent edge like that is everything.
Think of it like this. A normal roulette wheel in Vegas gives you about a 46% chance of hitting red. But what if you found a special wheel, one that paid on red 54% of the time? You'd never leave that table. You would own the casino. That is the kind of advantage momentum offers. Over hundreds of spins or trades, that tiny edge compounds into a massive advantage.
So the whole strategy can be summed up with a really simple mantra: buy the attic, stay out of the basement. You want to invest in the things that are performing the best, and you want to avoid the things that are doing the worst. It's that simple.
But, and this is a very, very important but, this strategy works best with big, broad asset classes. Things like ETFs for US stocks, international stocks, gold, bonds, that sort of thing. It's much less effective for picking individual stocks. The main reason is pretty simple: trading costs. The fees involved in buying and selling lots of individual companies can just eat away your profits.
So we'll leave you with this final thought, a simple rhyme that captures the whole philosophy perfectly. The trend is your friend until the trend is at its end. Momentum is an incredible tailwind, but you always have to remember that second line. Trends don't last forever. The key isn't just knowing how to ride the wave, but also knowing when it might be about to crash.
Okay, let's get right into it. We all work hard to build up our savings, right? That nest egg for the future. But what if the very system you trust to grow it is actually quietly draining it dry? Well, today we're pulling back the curtain on how Wall Street's game is played, and more importantly, how you can stop them from tapping your nest egg.
And, this isn't some newfangled concern. Way back in 1816, Thomas Jefferson was already sounding the alarm. He believed big banks were more dangerous than standing armies. That's a heck of a statement, and it really sets the stage for what we're about to uncover.
For a lot of people, that danger Jefferson talked about became painfully real during the 2008 financial crisis. I mean, look at this. Banks foreclosed on over 5 million homes to raise cash. And the craziest part? Many of those homeowners weren't even behind on their payments. Their lives were turned upside down, not by some accident, but by deliberate actions.
So just how deep does this rabbit hole go? Well, what we're looking at isn't just one bad event. It's a whole history of betrayal and harm. Now, the 2008 crisis wasn't just some big oopsie. Official reports called it a massive fraud, orchestrated from the very top. We're talking about banks gambling with our money, falsifying signatures to kick people out of their homes. It was so bad that the New York Fed president called it deep-seated cultural and ethical failures. A bipartisan commission even said there was a systemic breakdown in accountability and ethics. These aren't opinions. These are the official findings.
All right, so who were the actual players here, and what was the real price of all this misconduct? Let's take a look at what we're calling the gallery of rogues and the penalties they had to face.
For their part in all this, just 9 of the biggest banks on Wall Street ended up having to pay out an absolutely mind-boggling amount in settlements. They paid over $150 billion. Just let that number sink in for a second. That's not a slap on the wrist. That's the price tag for years and years of widespread, systemic bad behavior. So what exactly did they do to rack up a bill that high? Well, the list of charges reads like a how-to guide for financial crime.
Just look at this stuff: defrauding investors, rigging currency rates, manipulating the global interest rates that affect everything from your mortgage to your car loan. The key thing to see here is the pattern. This wasn't one bad apple or one bad day. It was how they operated.
Now, I know there's a ton of information here, so don't even try to read it all. Just get a sense of the scale. Look at Bank of America, for instance. Over $54 billion in settlements for everything from financial fraud to bad mortgage loans. And it just goes on and on. This rogues gallery shows that the problem wasn't with one bank. It was woven into the fabric of the biggest names in finance.
And here's the real kicker. The very same banks on that list of shame are the ones controlling most of America's wealth. We're talking trillions, with a T, of dollars under their management. So these aren't some distant villains. They are literally managing the retirement funds and nest eggs for millions of us. But okay, beyond all the huge headline-grabbing scandals, there's a much quieter, almost invisible way that your wealth is being siphoned off. And this is what our source material calls the long con.
Let's get personal. How does this subtle little game affect your money right now? How does this slow drain work so well, and why is it so dangerous for your future? Think about it this way.
A short con is like a pickpocket. It's fast, it's obvious, and you know right away your wallet is gone. But the long con, well, that's the slow, steady drip of broker fees. A percent here, a fee there. It feels like nothing, but over decades, it's absolutely devastating.
This next chart might be the most important thing you see today because it shows exactly how this long con plays out. Let's say you start with 100 grand. The blue line, that's your money. The orange line, that's what your broker makes in fees from your money. At first, things look great. Your account is growing, but just watch that orange line. It doesn't just grow. Thanks to compounding, it skyrockets. Okay, now focus right here, around year 23. This is the jaw-dropping moment. This is when your advisor has officially made more money from your account than you actually have left in it. By year 30, they've pocketed over $400,000 of your potential gains, while you're left with just $269,000. It's your capital, your risk, but they're taking the biggest slice of the pie.
But surely you're paying those high fees for something, right? For access to the smartest minds on Wall Street, for amazing performance? Well, let's see what the data actually says about that.
And this just blows that myth right out of the water. Over 10 years, a pathetic 12% of Goldman Sachs' expensive funds actually managed to beat their simple market benchmarks. Compare that to low-cost Vanguard, where almost half their funds did better. You are literally, and I mean literally, paying more to get worse results. It's wild.
Which leads us to that cynical old joke they tell on Wall Street. How do you make $5 million in the stock market? Simple. You start with $10 million at Goldman Sachs. It's supposed to be a joke, but as we just saw from the data, there's a painful amount of truth to it. Okay, so we've laid out a pretty big, pretty scary problem. But here's the good news. The solution is actually simple, and it puts all the power right back where it belongs, in your hands.
The single most powerful step you can take, according to our source, is to simply disinvest. And what that means is getting your money out of the hands of these giant banks that have shown time and time again that they can't be trusted.
So it really boils down to this simple 3-step plan. Step 1, get your money out. Step 2, transfer it to a low-cost bargain brokerage. And step 3, manage it yourself. This is so important because at the end of the day, nobody is ever going to care more about your money than you do.
So why don't more people do this? Well, it's all psychology. Check this out. Studies show that you're 3.5 times more likely to follow a guy jaywalking if he's wearing a business suit. That's called authority bias. The fancy suit, the corner office, it's all designed to make you trust them, even when all the numbers are screaming that you shouldn't.
And that leaves us with this one last, perfect thought to wrap it all up. It's called Livingston's Law, and it goes like this. Beware of those in fancy clothes. They charge high fees for things everyone knows. So the only question left is, now that you know, what are you going to do about it?
Have you ever watched those market experts on TV and wondered, do they actually know what they're talking about? Well, today we're going to dig into the data, and what we uncover might just change how you see Wall Street's crystal ball forever. All right, listen to this quote. This is far and away the strongest global economy I've seen in my business lifetime. Pretty bold, right? Sounds like it's coming from someone who really knows their stuff. You'd probably trust a statement that confident. Well, that was Henry Paulson, the U.S. Treasury Secretary at the time, and he said that in July of 2007, just 4 months before the Great Recession officially kicked off. Yeah, that colossal miscalculation gets right to the heart of what we're talking about today, the myth of the market expert. So it really makes you wonder, right? When we see somebody in finance who just keeps winning year after year, are we looking at a true genius, or are we just looking at someone who got really, really lucky? The answer is hiding in something as simple as a coin toss. Think about it. On Wall Street, if a fund manager beats the market for a few years in a row, they get put on magazine covers, right? They're treated like a visionary, a genius who's cracked the code. We just automatically assume it has to be skill. But what if it isn't skill? What if it's all just probability at work? Kind of like flipping a coin and, against all odds, getting heads 10 times in a row. Let me show you what I mean with a super simple thought experiment. Imagine we get 1,000 people together in a big room and we have each of them flip a coin 10 times. Just by the laws of probability, about 2 of those people will get 10 heads in a row. Now, would we call them genius coin flippers? Would we ask them for their secret strategy? Of course not. We'd all know it was just pure dumb luck. Okay, so let's take that same exact logic and apply it to the world of investing. What happens when we track these so-called genius funds over time? Do they really keep flipping heads? This brings us to a really important idea in finance called persistence. It's this belief that a fund that did great in the past is just going to keep doing great in the future. I mean, it sounds logical, right? A winner is going to keep winning. But is it actually true? So the folks at S&P Dow Jones Indices actually put this to the test. They took 715 funds that were all in the top 25% of performance back in 2010. They were the rock stars. And then they just watched them for the next 5 years. And what they saw was that these top funds, well, they started dropping like flies. So out of those original 715 top performing funds, how many do you think actually managed to stay in that top bracket for all 5 years? Just take a guess. The answer is 2. Not 72, not 20, just 2. And you know, the story gets even better because the very next year, both of those last 2 genius funds, they fell into the bottom half of the rankings. Their lucky streak was over. It turns out that persistence, that idea that winners keep winning, it's pretty much a myth. Luck just runs out. Okay. So individual fund managers might just be lucky coin flippers. But what about the big banks, the huge teams of super smart, highly paid strategists with all their fancy computer models? Surely they can predict where the market's headed, right? Well, you might want to sit down for this. The data is kind of shocking. Since 1999, Wall Street strategists as a group have never, not one single time, predicted a down year for the market. Their average prediction every single year is for a gain of about 9%. And get this, half the time, their predictions are off by a massive 10 to 50 percentage points. This is my favorite part. One analyst actually created a fictional character called the blind forecaster. This guru does nothing but predict a 9% gain every year, no matter what's happening in the world. And it turns out that ridiculously simple formula is often more accurate than the collected wisdom of Wall Street's best and brightest. So, the key takeaway here, the big idea, is incredibly simple. The future cannot be predicted, not by a star fund manager, and not by a whole army of expensive analysts. And now, let's look at the ultimate test case. A moment in history when an accurate prediction would have saved millions of people from absolute financial ruin, the 2008 financial crisis. So let's set the scene. It's late 2007. The housing market is clearly in deep trouble. A recession had actually already begun. The warning signs weren't just there, they were flashing bright red. So out of all the major banks, which ones saw the crash of 2008 coming? Here they are. These are the official year-end predictions for the S&P 500 from every single major bank. What did they see on the horizon? Not one of them predicted a crash. Not one predicted a fall. Every single one, from Lehman Brothers to Goldman Sachs, said the market was going to go up. Their average prediction was for a gain of more than 10%. And what actually happened? The market crashed by 38.5%. This is one of the greatest failures of expert prediction in modern history. I mean, they weren't just wrong, they were spectacularly wrong, in the exact opposite direction. It's such a powerful reminder of this simple truth. When you hear an expert confidently tell you what the market's going to do next year, they're just guessing. Really, it's in their best interest to sell a positive story, to tell people what they want to hear, that things are always going to go up. So after hearing all this, you're probably thinking, okay, great. What am I supposed to do with this information? How can you actually use this to be a smarter and maybe even a calmer investor? There's this old saying that just nails it perfectly. Anyone who knows doesn't say, and anyone who says doesn't know. Think about it. If someone could actually predict the future, they wouldn't be shouting about it on TV. They'd be quietly becoming the richest person on earth. And you know what? This is actually incredibly good news. It means you have official permission to just ignore all the noise. You don't have to pay crazy high fees for advice that's basically worthless. And most importantly, you can free yourself from all the stress and anxiety that comes from trying to follow every single forecast. Which leaves us with one last, really big question. If the so-called experts can't predict the future, then who or what can you actually trust? Maybe the answer isn't about finding a better fortune teller. Maybe it's about building a solid strategy that doesn't need one in the first place. And that's a thought worth hanging on to. Planning for retirement, it can feel like you're walking through a minefield, right? You spend decades saving and investing, but what happens if you retire at the absolute worst possible moment? Well, today, we're going to dive into a crucial secret for a secure retirement. And believe it or not, it all comes down to understanding the next 10 years. There's an old saying on Wall Street that just nails our human nature. We spend all our time looking at the past, stressing about what's happening right now, and then dreaming about the really distant future. But what if the single most important period to understand is the one that's just around the corner? And that brings us right to our first section, retirement roulette. Because, and this is kind of terrifying, for a lot of people, the success of their retirement comes down to a whole lot of luck, specifically the luck of when they decided to hang it up. Okay, so take a look at this. This chart tells an incredible story about two different retirees. One is Mr. Red, who retired at the end of 1971, and the other is Miss Blue, who retired at the end of 1983. Now, here's the crazy part. Both of them get the exact same market returns over the years, just in a different order. And they both withdraw the same 5% a year. So how is it possible that one goes completely broke while the other's portfolio just thrives? This is the kicker. Mr. Reb retired and was immediately hit with a string of really weak returns. Those early losses, combined with his withdrawals, just crippled his portfolio. Ms. Blue, on the other hand, got strong returns right out of the gate, which gave her portfolio a cushion that lasted for decades. They experienced the same market, just in reverse. This is what's known as sequence of returns risk, and it is an absolute nightmare for retirees. So, the big question is, how do you protect yourself from this? How do you avoid becoming Mr. Red, where your entire retirement plan gets derailed just by bad timing? Is there any way to see what might be coming? And that leads us to a really fascinating idea, what we're calling the 10-year exception. See, we're always told that predicting the market is a fool's game, right? But it turns out there's a pretty huge exception to that rule. Yeah, we've all heard it a million times. No one can time the market. And look, when it comes to predicting what the S&P 500 is going to do tomorrow or next week or even next month, that is 100% true. It's a total crapshoot. But what happens if we zoom out a bit? And this slide explains it perfectly. It turns out there are different kinds of chaos. You have something that's predictably random, like a coin toss. You have no idea what the next flip will be, but you know over the long run it's going to be 50-50. Then you have something like the weather, which is predictably chaotic. The forecast for tomorrow is probably pretty good, but the 10-day forecast, forget about it. And then you have the stock market, which is wildly chaotic. And this is the key. It means that while tomorrow is a complete mystery, we can actually estimate the long-term outlook, say the next 7 to 15 years, with a surprising amount of accuracy. So how can we actually use this idea? Well, let's turn to an investing giant, the founder of Vanguard himself, Jack Bogle. He developed a practical tool based on this very concept. Bogle came up with this pretty simple model to project the S&P 500's return over the next decade. Just look at this chart. The purple line is what his model predicted, and the orange line is what actually happened. It's not perfect, but look at how well it calls the major peaks and troughs over decades. It's an incredibly powerful guide for what might be ahead. So, what was the number? What did Bogle's crystal ball predict back in 2017 for the decade ahead? Just 4%. A nominal annual return of only 4% for the S&P 500. And you gotta remember, that's a nominal return. That's before you account for inflation. So if inflation is running at, say, 2 or 3%, your real return, the actual growth of your buying power, is a measly 1 or 2%. That is a completely different world from the double-digit returns that a lot of us have gotten used to. Now, you might be thinking, okay, but that's just one guy's model. And that's fair. But what's so compelling here is that he is absolutely not alone. Let's take a look at what some of the other biggest names in finance are saying. Okay, so check this out. This chart lines up 4 different forecasting methods from 4 different experts. And what do you notice? As of early 2018, they are all singing the same tune. They're all pointing in the same direction, down. They're all predicting a decade of flat or even negative real returns for US stocks. Let's just break this down for a second. You've got Nobel Prize winner Robert Shiller predicting a real return of basically zero. James Tobin's model, also a Nobel winner, is projecting a small negative return. And then you have the method favored by Warren Buffett himself, which is projecting a staggering negative 5.3% real return per year. These aren't just some fringe theories. They're based on time-tested ways of valuing the market.
So what in the world are we supposed to do with all this? How should we react? Well, that brings us to our final and maybe most important section, which comes with a simple story that perfectly explains the psychology of an expensive market. All right, the story goes like this. A man shows up in a village and says he'll buy monkeys for $10 apiece. The jungle is full of monkeys, so the villagers go out, catch them all, and sell them to the guy. It's the easiest money they've ever made. Then the man comes back and says he'll pay $20 for each monkey. It's a lot harder now, but the villagers manage to find a few more. The price just keeps going up, first to $20, then all the way to $40. Finally, the man says he has to go back to the city for a bit, but he leaves his assistant in charge. By now, there are basically no monkeys left to be found. But the assistant pulls the villagers aside and offers them a little deal. He says, "Hey, look at all these monkeys in the cage. I'll secretly sell them back to you for $30 each. When my boss gets back, you can sell them to him for his standing offer of $40. Well, the villagers see a guaranteed profit. It's a no-brainer. So they pool all their life savings, every last penny, and they buy every single monkey back for $30. And then they wait. And they wait. And they never see the man or his assistant ever again. They're just left holding a cage full of worthless monkeys. And now you know how the stock market works. It's such a powerful story about speculation, right? About buying something not because of what it's worth, but because you're convinced some greater fool will come along and buy it from you for a higher price later on. That story is a huge warning. And the real takeaway from all these expert forecasts is actually pretty simple. It's captured perfectly in what's called Livingston's law of choice. Stocks can go down for years at a time. Diversify now for your own peace of mind. When valuations are sky high and future returns are expected to be low, putting all your eggs in one basket is the absolute riskiest move you can make. And that leaves us with one last, really critical question you have to ask yourself. Knowing that so many experts are forecasting a tough, challenging decade for U.S. stocks, is your portfolio built to handle that? Is it really prepared for a sideways decade? Definitely something to think about.
Hello and welcome. Let's get right to it. What is the single biggest threat to your investment portfolio? You might think it's a market crash or a shaky economy, but it's not. The real enemy is the 3 pounds of gray matter sitting right between your ears. That's right, the biggest obstacle to your own financial success is, more often than not, your own mind.
Okay, so to really get into this, let's start with a quote from a 19th century businessman named Walter Bagehot. He basically figured out that we human beings hate uncertainty so much, we would rather jump to a quick conclusion, even if it's the wrong one, than just sit with that uncomfortable feeling of not knowing. And this is a huge deal because when it comes to investing, a hasty opinion can be absolutely catastrophic.
All right, I'm going to be blunt here. You probably think you're a pretty decent investor, right? Well, that belief right there is your single biggest problem. It might sound a little harsh, I know, but stick with me, because the science behind why this is true is just fascinating.
To really understand why we get in our own way, we have to look at how our brains are actually wired. This isn't about financial theory. It's about pure biology. It's about your brain on money.
So think of it like this. You've basically got 2 different command centers running the show in your head. Normally, your rational, higher mind is in charge. But the second you start losing money, a switch gets flipped. Control gets handed over to a much older, much more primitive part of your brain, your instinctual, lower mind.
Let's break that down. Your prefrontal cortex, that's the CEO. It's calm, it's calculating, and it's great for making smart, logical decisions when there's no real money on the line. But your amygdala, some people call it the reptilian brain, well, that's your head of security. It's built for one thing, survival. And when it senses a threat, like your portfolio tanking, it hijacks the whole system and just screams one of 2 things: fight or flight.
And here is the fundamental problem. Our brains evolved over thousands and thousands of years for really simple one-to-one threats. Stimulus, see a hungry tiger. Response, hide. It's a brilliant system for keeping you alive out on the savannah.
But it is just not built for the modern stock market, which throws millions of confusing data points at us, not one single clear threat.
So, what exactly happens when that tiger-fearing brain suddenly gets handed the keys to your entire life savings? Well, let's take a closer look at the anatomy of panic.
You know how financial advisors always ask about your risk tolerance, as if it's some fixed part of your personality? Well, this chart from the 2008 crisis just blows that whole idea right out of the water. The orange line, that's the S&P 500. The purple line shows investors' actual risk tolerance. You see it, right? As the market just plummets, so does their willingness to take any risk at all. Our willpower completely collapses at the exact moment we need it most.
We know our resolve just crumbles under pressure. But is there a specific number, a clear trigger point, a line in the sand where our rational brain just throws its hands up and surrenders control?
It turns out, yeah, there is. It's this number. A loss of about 25%. This is what researchers call the behavioral pain point. When a portfolio drops by this much, it seems to trigger a mass instinct to just sell everything and get out, no matter what the long-term consequences might be.
And what are those consequences? Let's talk about the incredibly high price we pay for acting on that deep-seated, hardwired fear.
This chart right here might be one of the most important charts in all of finance. The orange line shows you what the market returned. The purple line shows what an investor did if they sold after a big drop and then waited a year to get back in. That giant space between them, that is the behavior gap. And it's the real, measurable cost of letting fear drive your decisions.
Simply put, the behavior gap is the difference between what your investments earn and what you, the investor, actually get to keep. Studies show this gap costs the average investor more than 2% a year. Now, 2.2% might not sound like a huge number, but over an entire career, that can literally cut your final retirement nest egg in half. It is a massive, self-inflicted financial wound. See, selling at the bottom is a double disaster because of how market cycles tend to work. First, you get the bear phase. That's the 25% loss that causes all the panic. But look what happens right after that, the bounce. On average, you get a massive 51% gain in just the first 10 months of the recovery. If you panic sell during the bear, you miss out on the single most profitable part of the whole cycle.
This chart just lays that devastating mistake out perfectly. You suffer through all the pain of that red bear phase, you sell at the very bottom out of sheer terror, and then you just sit on the sidelines while the market rockets back up in that green bounce phase. Missing that explosive recovery, that is the true crushing cost of fear.
Now, I know what you might be thinking. Oh, that won't be me. I'm strong, I've got the willpower to just ride it out. But here's the thing. When it comes to our survival instincts, willpower is simply no match. It's not enough.
And hey, if you don't believe me, let's just take a look at one of the most brilliant, rational minds in all of human history, Charles Darwin. He actually ran an experiment on himself at the London Zoo to test this exact idea of mind over instinct.
These are Darwin's own words. He was determined. He used every ounce of his famous intellect and willpower, not to flinch if a venomous snake struck at the glass right in front of his face. But the instant the snake struck, he said his resolution went for nothing. He jumped back instinctively. His higher, rational brain was completely overruled.
And here's why that happened. Biologically, the threat signal travels to your amygdala, your survival center, on a kind of neurological superhighway. But the signal only gets to your cortex, your thinking center, on a slower, winding side road. So you react before you even have time to think. It's a feature, not a bug. It's designed to save your life from a snake. But it's a bug that absolutely destroys your portfolio.
So if we can't overpower our own brains with sheer force of will, then what in the world can we do? Well, the key isn't to try to be a better, more rational human. It's to use a better system. It's all about outsmarting your own brain.
Check this out. This table shows the results from a real-world experiment. An investment firm offered its clients two types of accounts. One was fully automatic, run by a computer formula. The other gave investors the exact same picks from the formula, but let them use their own judgment to override it. The results are just staggering. The investors who helped the computer did way worse, even failing to beat the market. The lesson is just stunning. Having more information and more control actually led to worse results.
And if you think, oh, that just applies to regular people, think again. Long-term capital management was a hedge fund literally run by Nobel Prize-winning economists. They were, without a doubt, the smartest guys in the room.
And in 1998, their incredibly complex models blew up, and they lost 90% of their money in just 4 weeks. It's the ultimate proof that no one is immune to these deep-seated biases.
All of this leads to a condition we can call financial blindness. It's that dangerous state you get into where just being exposed to all the market numbers causes your emotional, lower mind to take control. It starts feeding you really bad financial decisions that your rational brain somehow convinces you are perfectly logical.
And so this leaves us with one final, pretty unsettling question to think about. We've seen that our instincts are wrong, our willpower isn't enough, and even genius-level intelligence can lead us completely astray. So if you can't trust your own brain with your money, what can you trust?
All right, let's just dive right in. The title of this explainer is pretty bold, isn't it? You don't need indicators that don't really indicate. We're about to unpack why so many of the tools investors use to get an edge might actually be doing the exact opposite. You know, when we look at the market, it's so tempting to search for some kind of secret formula, right? That one little trick that's going to tell us what's next. It's kind of like shaking a magic 8-ball and hoping for a stock tip. But, as you can see here, finding that secret formula? Yeah, you probably shouldn't count on it.
And this really gets to the heart of the matter. The market just isn't that simple. You can't boil it down to a neat little equation. I mean, it's way, way more complicated than that. But that's exactly what people try to do when they get obsessed with so-called market indicators.
So what exactly is a market indicator anyway? Well, think of it like a recipe. It's a ratio of a couple of different market metrics, all mixed together to try and signal when you should buy or sell. The problem is, as the slide kind of hints, these recipes don't always taste as good as you'd hope.
Which brings us to an interesting question. When it comes to making predictions, are you smarter than a lab rat? The answer from this really surprising story might not be what you think.
Okay, so picture this experiment. Researchers build a super simple maze. Cheese is randomly put on the left side 60% of the time and on the right side 40% of the time. The setup is simple, but what happened next is just fascinating.
And they tested 2 groups, lab rats and economics grad students. The rats, well, they figured out the odds pretty quick. They saw that the cheese was usually on the left, so they just went left every single time. Simple. The students, on the other hand, did exactly what you'd expect smart people to do. They overanalyzed it. They tried to find a hidden pattern in the randomness. This is basically what traders do when they backtest a strategy.
So who won? It's kind of hilarious, actually. The lab rats, with their dumb, simple strategy, were right 60% of the time. The brilliant grad students, with their complex formulas, were only right 52% of the time. They were barely better than flipping a coin. By trying to be too smart, the humans actually did worse. All right, so let's move from a lab experiment to the real world. Let's take a little tour through the graveyard of good indicators gone bad. It's filled with ideas that once looked so promising.
Let's talk about a famous one, Bollinger Bands. For a long time, this was the hot tool in technical analysis. It looked all scientific, you know? It uses a stock's moving average to create these bands that are supposed to tell you when to buy and sell. And for a while, it seemed like it actually worked.
But just look at what happened over time. Before anyone really knew about the formula, it was super profitable. Then, once it got introduced publicly in '83, its effectiveness got cut in half. And then, after a book was published about it, making it even more popular, its profitability just completely collapsed. So what on earth is going on here?
Well, there's a perfect name for it: overgrazing. Think about it like a public field. When only one farmer's cows are there, there's plenty of grass for everyone. But as soon as the secret's out and everybody brings their cows, the field gets stripped bare and it becomes useless for anybody. That's what happens to market indicators.
Okay, you might want to buckle up for this next one because it's a bit weird. Believe it or not, study after study has shown that one of the most reliable statistical patterns in the stock market is the phase of the moon. I'm totally serious. Markets all over the world tend to do better around a new moon than a full moon.
So why aren't all the big hedge funds trading based on the lunar cycle? Well, because a pattern being statistically real and being a profitable strategy are 2 very different things. First, the transaction costs of buying and selling every 2 weeks would be insane. Second, you'd miss out on a lot of gains, because even on the weaker days, the market still tends to go up over time. The end result? You'd do way, way worse than just buying and holding.
And all this leads us right to the main event.
Data mining and random chance. Forget one-off examples. Let's see what happened when someone decided to test pretty much every indicator out there.
There's this great saying on Wall Street: if you torture the data long enough, it will confess to anything. And that perfectly sums up the problem here. If you look back at past market data, you'll always find something that looks like a brilliant pattern. But is it real or just an accident?
So this researcher, David Aronson, he put this idea to the ultimate test. He didn't just look at a few indicators, he ran a massive study, backtesting 6,402 different trading rules over a 25-year period. I mean, what an undertaking.
So, out of more than 6,400 different rules, after he corrected for just pure random luck, how many of them actually worked? The answer is 0. A big, fat 0. Not a single one could be proven to be anything other than statistical noise.
And this is all because of something called data mining bias. It's basically a statistical trap. If you test enough random ideas on the same set of data, one of them's gonna look like a winner just by chance. It's inevitable. But that perfect strategy you found in the past, it's almost guaranteed to fall apart in the future. Okay, so if we've just pretty much debunked thousands of complex indicators, what are we left with? Well, this final section is all about the simple, powerful alternative. It's just about price. The simplest signal, and maybe the only thing you really need to know.
And that's the big question, isn't it? If all these fancy formulas and secret ratios are basically useless, what's an investor supposed to do? What's actually left to work with?
Well, the argument is that through all of that noise, all the chaos and distractions, there's one single factor that stands head and shoulders above everything else. And that factor is simply price. That's it. Not a ratio, not a complicated formula from a guru, just the price of the thing you're looking at. It's the cleanest and most powerful signal there is.
So what makes price so different? Well, first, it's not an indicator. It's not a ratio of different things. It's the real thing. The price is just the price. Second, that one number contains an unbelievable amount of information. It's the sum total of every bit of fear, greed, hope, and analysis from every single person in the market. And for that reason, it's arguably all an informed investor ever really needs.
Which leaves us with this final, incredibly simple takeaway. It even rhymes, so it's easy to remember. Indicators come and go. Price is all you need to know. That's definitely something to think about the next time you're tempted to go searching for another secret formula.
Let's talk about investing. You know, when it comes to growing our money, it turns out that our own brain can be our absolute worst enemy. Seriously, we get emotional, we panic, we get greedy, and all of that costs us big time. But what if there was a way to take that messy, flawed human nature completely out of the equation? Well, let's dive in and find out how. The legendary investor Peter Lynch just completely hit the nail on the head with this one. It's a perfect way to show how irrational we can be. I mean, think about it. When the price of literally anything else drops, we see a bargain, right? A deal. But when stock prices go on sale, our gut instinct is to run for the hills. And that reaction, that's exactly what gets investors into so much trouble, causing them to sell low and buy high, over and over again. So this really is the million-dollar question. If even the pros, with all their fancy charts, get it wrong half the time, and our own gut feelings just lead us astray, how is anyone supposed to win this game? It really seems like it's rigged against our own psychology. But it turns out there is an answer, and it has absolutely nothing to do with guesswork or crystal balls.
To find that answer, we first have to look at the two roads most investors usually go down. And as you're about to see, both of them are full of some pretty serious potholes.
Okay, so on one hand, you've got active investing. This is where people try to outsmart the market, using complex indicators and making lots of trades. The problem? Our emotions almost always end up overriding the system, and all those trading fees just chew up your profits. Then, on the other hand, you have passive investing. This is where you just buy a fixed set of stocks or funds and hold on for dear life. It's simple for sure, but that rigidness is its biggest weakness. It never adapts, which leaves you completely exposed when a massive bear market comes along.
All right, so if active guessing is a mess and passive holding is too rigid, there has to be a third way, right? And there is. This brings us to a much, much smarter approach: mechanical investing.
At its heart, mechanical investing is actually pretty simple. It isn't about having a better opinion or a hotter tip, it's about having no opinion at all. It relies 100% on a preset computer formula to make every single buy and sell decision. It systematically removes all the emotional baggage, all the guesswork, and all the failed predictions from the entire process. Think about it like this for a second. If you had $1 million on the line in a chess match against a world-class grandmaster, would you rely on your own gut feeling? Of course not. You'd pick the supercomputer to make your moves every single time, no question. Well, investing is an equally complex game, so why on earth should we treat it any differently?
And look, this isn't just a theory. The proof goes back decades. Ever since IBM's supercomputer, Deep Blue, defeated the reigning world chess champion Garry Kasparov way back in 1997, it's been crystal clear. For complex, data-heavy games, computers can make strategic choices far better than even the most brilliant human minds. And today, we can use that very same power for our own portfolios.
Okay, so how does this actually work in the real world? Well, the whole system is built on 3 core principles that, when you put them together, create what the source material for this explainer calls a muscular portfolio. Let's break down exactly what that means.
The system is built just like a 3-legged stool. It's simple, it's stable, and it's incredibly strong. Each leg stands for a fundamental principle of investing. And just like a real stool, if you take away even one of those legs, the whole thing gets wobbly and completely unreliable.
So these 3 legs all work together to hold up the whole portfolio. First up is compounding. This is just the magic of letting your money grow on its own. It's the real engine of wealth creation. The second leg is diversification. This means staying fully invested across at least 3 different types of assets, like stocks, bonds, or maybe real estate, which helps smooth out the ride. And the third leg, this is the secret sauce, it's momentum. The system automatically rotates your money into whatever asset classes have been the strongest lately. It lets you ride the winners and cut the losers loose, all without you ever having to guess what's next. Now, having a great system is one thing. That's half the battle. But the real challenge, the part that trips almost everyone up, is having the discipline to actually stick with it, especially when the market gets scary.
Just look at this number. It's staggering. A big study from Vanguard found that of the very, very few actively managed funds that actually managed to beat their benchmark over 15 years, a whopping 97% of them still underperformed that same benchmark for at least 5 of those years.
This is what's known as the long night of the portfolio. And what it means is that even the absolute best, most successful strategies will go through long stretches, sometimes 5 years or more, where they're lagging behind a hot index like the S&P 500. This is the ultimate test of an investor's patience. And honestly, this is the exact point where most people lose their nerve, abandon their strategy, and end up missing out on all the long-term rewards.
But an informed investor, they get this. They don't get distracted or feel like they're missing out during those roaring bull markets. They know that a strategy that's built to protect them from huge losses is naturally going to lag when everything is just going straight up. And that patience is always rewarded over a full market cycle because they avoid the catastrophic crash that just wipes out all the emotional, short-sighted investors.
To really develop that kind of patience, we have to totally redefine a word we hear all the time. We're all trained to believe that volatility, the market's daily ups and downs, is risk. It's not. It's just the normal tide of the market. And for a mechanical system that follows rules, that tide is actually an opportunity.
This image captures what true financial risk really is. Think of it like this. If you build a house on the beach, volatility is just the tide going in and out every day. It's normal. Real risk, that's the once-in-a-decade hurricane that comes through and completely demolishes your house. In investing, true risk is a loss so massive, so intolerable, that it forces you to sell at the absolute bottom, locking in losses you can never, ever recover from. The goal isn't to avoid the daily tides, it's to make sure your house is built to survive the hurricane.
So as we wrap things up here, the question you really have to ask yourself is this. Is your financial house built on the shifting sands of emotion and prediction, or is it built on a solid foundation of stone, a system designed to withstand whatever storm the market decides to throw at it? You've seen the ads, right? All these platforms promising commission-free trading. It sounds amazing, like we can build our wealth for next to nothing. But is it really the whole story? Is it maybe a little too good to be true? Well, let's pull back the curtain and see what's actually going on behind the scenes of so-called commission-free investing. And to kind of set the stage here, check out this quote from investor William Bernstein. I mean, yeah, it's a little cynical, sure, but it's a fantastic reminder that in the world of finance, it really pays to be skeptical and to always dig a little deeper than the marketing slogans.
And that's exactly where the skepticism comes in handy. I mean, look at these names: Schwab, Fidelity, TD Ameritrade. These are the giants of the industry. And let's be real, they're not charities, right? They are for-profit businesses. So the billion-dollar question is, where's the money coming from if they're not charging commissions?
Okay, so that leads us right into our first big topic. We're going to go ahead and bust the commission-free myth and uncover what you're really paying for.
Now, don't get me wrong, the fact that you and I can manage our own IRA or Roth accounts using low-cost ETFs is an absolute game changer. I mean, we have more control over our financial future than ever before. But with that power comes a big responsibility. You got to be on your toes, because as you see here, commission-free is definitely not the same thing as cost-free.
All right, let's meet our first villain of the day: hidden fees. These are those sneaky little charges that can just quietly and systematically drain your returns over time, often without you even realizing it's happening.
Okay, here's a perfect example. 12B1 fees. Yeah, it sounds super technical, I know, but trust me, the idea is actually pretty simple. A slice of your own money, we're talking anywhere from 0.25% to a full 1% every single year, is taken out to pay for the brokerage's marketing. Think about that. You're literally paying for their TV commercials and online ads.
And this quote from Dan Kaplinger at The Motley Fool just hits the nail on the head. The problem is these fees are baked right into the funds themselves. So even if you don't use that particular broker to buy a fund, a slice of that fund's fee is going straight into the broker's pocket anyway. It's kind of crazy.
All right, here's another sneaky one for you, something called cash drag. A great example is Schwab's free intelligent portfolio service. Sounds great, right? Free portfolio management. But there's a catch. They force you to keep a big chunk of your portfolio just sitting there, in cash.
And what's crazy is just how much we're talking about here. Look at this, anywhere from 6 to 30% of your money. So while your cash is basically collecting dust in a low-yield account, Schwab is out there lending it out and making a nice profit for themselves. That drag on your returns is a huge hidden cost, especially if you have a bigger account.
Oh, and it doesn't stop there. Some places hit you with platform fees. Others, like TD Ameritrade, have been caught adding their own little fees on top of an ETF's normal expense. And you've got to watch out for penalties, like getting charged if you sell a commission-free ETF in less than a month. You can see how all these little nicks and cuts can really add up over time.
So hidden fees are one piece of the puzzle, but there's another cost that gets you every single time you make a trade. And this one's a little more invisible. It's called the spread.
Okay, so what on earth is a bid-ask spread? Think of it like this. You go to the currency exchange at the airport. There's one price to buy euros and a slightly worse price to sell them back. That little difference between the buy and sell price, that's the profit for the exchange. It's the exact same thing with stocks and ETFs, and it's a cost you pay on every single trade.
So that leads to a really important question for any investor. If this spread is a cost we have to pay, when is that cost the absolute highest? What is, without a doubt, the worst possible time to hit that buy or sell button?
And wow, this chart tells you everything you need to know. Just look at the left side there. The moment the market opens at 9:30 a.m. Eastern, the spreads on all these different ETFs just go crazy wide. They are at their absolute peak in that first hour. The pros even have a name for this time of day. They call it amateur hour.
And this quote from Michael Murphy, a hedge fund manager, just sums it up perfectly. That first hour is when all the novices rush in, trading on news from overnight. The market makers widen the spreads to protect themselves from all that chaos. The smart money, they just wait.
So look, if you take away just one thing from this whole explainer, let it be this. Do not, under any circumstances, place a market order when the market is closed or in that first hour of trading. If you do, your order is probably going to get filled at a way worse price, and you're just throwing money away for absolutely no reason.
All right, so we've unmasked the villains. We're talking hidden fees and sky-high spreads. So now let's talk about the heroes. How do we fight back? What are the right tools for the job to keep our costs low?
Okay, so let's look at a couple of options here that are designed to help you avoid these problems. On one hand, you've got Robinhood. For smaller accounts, say under 10 grand, it can be a really solid choice with genuinely $0 trades. The catch? It's only on your phone, and it doesn't support retirement accounts like IRAs. On the other hand, for bigger portfolios, a platform like Folio Investing is way more powerful, has full IRA support, and this is key, it has something called window trades, which is the perfect solution to that amateur hour problem.
And if we dig into Folio's plans, you can kind of see how it works for different people. The basic plan is awesome if you don't trade very often. But let's say you're rebalancing a few times a year, maybe for yourself and your spouse. That unlimited plan becomes a much better deal pretty quickly. You just got to do a little math based on your own habits.
Okay, so now we know the dangers, and we've got some tools. Let's wrap this all up into a simple, actionable playbook you can use to protect your money and actually keep more of your hard-earned gains.
It's just 3 simple rules. That's it. Rule number 1. Never trade before 10:30 a.m. Eastern. Just avoid amateur hour completely. Rule number 2. If your broker has them, use window trades. They're designed to automatically execute your trades during quiet times of the day. And rule number 3. Before you hit that trade button, just take a quick peek at the spread. If it looks unusually high, something's weird. Maybe it's a flash crash. Just step away and wait. And check this out. This is a perfect example of how a good platform makes your life so much easier. Instead of you having to do all this complicated math to figure out how many shares to buy or sell to rebalance your portfolio, a system like Folio just lets you type in the percentages you want. The software does all the heavy lifting for you. It's brilliant.
Look, I get it. Getting all this set up and figuring it out can seem like a lot at first. It can feel a little daunting. But the big thing to remember is, you don't have to go it alone. Any good modern brokerage is going to have the tools and, maybe more importantly, live human beings you can talk to help you get everything moved over and set up the right way.
So let's end with this. We'll call it Livingston's Law of Bargain Brokerages. Finding a firm where your orders can flow means using a broker that keeps your costs low. Because at the end of the day, it's not about finding a broker that's free. It's about being smart. It's about understanding all the costs, both the ones you can see and the ones you can't, and choosing a platform that helps you keep your total costs as low as humanly possible. Hey everyone, and welcome. Today, we're going to talk about a smarter, way simpler, and honestly, a much less stressful way to keep your investment portfolio right where you want it to be.
So I want to start with this quote from Ben Carlson, because it really flips a common idea in finance on its head. You know, the one that says being complicated means you're sophisticated? Well, he argues that for most of us, admitting that less is more with our investments, well, that's not a sign of being clueless. It's actually the exact opposite. It's smart.
And that really gets us to the heart of what we're talking about today. We all know we're supposed to rebalance our portfolios, right? But the constant checking, the tinkering, it can feel like a full-time job. So the question is there a better way? A way to stay on track without obsessing over every little blip in the market? Well, the answer is a big yes.
All right, so let's start with the basics, just to make sure we're all on the same page. In this first part, we're going to break down what rebalancing actually is and why it's so important for any long-term investing plan.
You know, in the simplest terms, it's really just about sticking to your original game plan. Think of it like a recipe. When one ingredient, say your stocks, gets way too big, you trim a little bit of it. Then you use that to top up the ingredient that's gotten smaller. The whole point is to get back to the mix you decided on from the start.
Now here's the kicker. This isn't just about playing defense and managing risk. It can actually boost your returns. I mean, studies have shown that a disciplined rebalancing strategy can add almost 0.5 percentage point to your return every single year. And that little edge, over decades, it compounds into a huge difference. And this, right here, shows you exactly what happens if you don't rebalance. So let's say you start with a simple 50-50 split between stocks and bonds, but then stocks go on a tear for a few years. Before you know it, your portfolio has drifted, and now it's 70% stocks and only 30% bonds. All of a sudden, that balanced medium-risk portfolio you built is way more aggressive and way more vulnerable if the market takes a dive. That's the real danger of portfolio drift.
Okay, so if portfolio drift is the bad guy here, how do most people fight it? Well, in this next section, we're going to look at the classic textbook answer, the conventional 5% rule that you've probably heard about for years.
Yep, the magic number in the old school playbook is 5%. The rule of thumb has always been, hey, if any part of your portfolio gets more than 5% away from where it's supposed to be, it's time to step in.
And the logic behind this makes sense, right?
You check your portfolio maybe once or twice a year, and if anything is 5% off, you fix it. You'll see big firms like Vanguard supporting this idea. They argue it's a good middle ground. It keeps your risk in check without making you trade so often that the costs eat up your returns. For a long time, this has been the standard way of doing things.
But what if the standard way isn't the best way? In this section, we're going to dig into what we're calling a more muscular approach, one that's built on the idea that a little patience can be a very powerful tool.
So the new magic number? It's 20%. And I know what you're thinking. That sounds like a massive jump from 5%. And it is. This whole philosophy is about letting your investments run, letting them breathe, and only stepping in when things get really out of whack.
I mean, you can really see the difference in thinking here. The 5% rule, that's all about precision. It's about frequent, tiny little adjustments. But the 20% rule is about making moves that actually matter. It means way less monitoring, a lot less stress, and, this is the big one, it lets your winning investments keep on winning for a lot longer before you have to trim them back.
Okay, so this muscular approach sounds pretty good in theory, but how do you actually do it? Let's get practical and break down the super simple 3-step game plan.
Here are the rules of the road. First, just a quick peek at your portfolio once a month. That's it, no daily obsession. Second, you only do something, anything at all, if one of your assets is 20% over or under its target. And third, and this is the really clever part, you don't rebalance all the way back to zero. You just rebalance halfway, bringing it back to a 10% difference.
Okay, so let's see how this actually plays out. Take a look at that blue line for ETF 1. It started out with a target of $100, right? But over 9 months, it just zoomed away and shot past $120. That hits our 20% trigger. So what do? You sell a little bit of it. But, and this is key, you don't sell it all the way back down to $100. You just sell enough, in this case about $11, to get it back into that 10% band. Then you take that cash and you put it into your worst performer, which is ETF 3. It's simple, it's effective, and you hardly ever have to do it. And this rebalance halfway trick, it's absolutely brilliant. See, by selling less, you automatically cut down on your trading costs. But maybe even more important, if you're investing in a regular taxable account, this move directly lowers the capital gains taxes you'd have to pay. So you get all the benefits of rebalancing, but with way less of the downside.
All right, let's bring it all home. For our final section, we're going to talk about why less is more really is the mantra here, and how this whole strategy is built on the incredibly powerful idea that sometimes the absolute best move you can make is to do nothing at all.
And hey, this isn't just a gut feeling. There's actually data to back this up. A study from CXO Advisory basically found that sweating the small stuff, those little drifts of a few percentage points, it just doesn't really change your long-term results in any meaningful way. It's okay to just let it ride for a bit.
So the big takeaway here is this. When you adopt this simpler, more patient approach, you end up reducing your trading costs, you lower your potential tax bill, and you just slash the financial stress in your life, all while giving your best performing investments more room to grow. It's a win-win-win.
And look, if you forget everything else we talked about, just try to remember this little rhyme. It just captures the spirit of this whole thing perfectly. You don't need a huge reaction, just a little nudge, and only when it's really, truly needed.
So we'll end on this question, which brings us full circle, right back to that quote we started with. In a world that's always screaming at us to do more, trade more, check our portfolios more, maybe, just maybe, the most intelligent and profitable move we can make is to have the discipline to just step back, be patient, and do a whole lot less. Thanks so much for joining me.
All right, let's talk about what is very likely your single biggest investing expense. It's one that often hides in plain sight: taxes. But more importantly, we're going to lay out a playbook for how you can win what we're calling the game of life savings. There's this great quote from a Bill Murray parody account on Twitter that just nails it. The best way to teach your kids about taxes is by eating 30% of their ice cream. It's hilarious because it feels so true, doesn't it? It perfectly captures that feeling of loss. And trust me, when it comes to your life savings, we're talking about a whole lot of ice cream. Look, we spend so much time and energy worrying about management fees and expense ratios. And yeah, those are important. But for a lot of us, the real silent killer of our returns is the bite that taxes take out of our gains year after year. If you don't have a plan, taxes can quietly become the single biggest expense you have as an investor. So let's dive right in. Our first section is all about that biggest expense, the silent killer of returns. I want you to see just how much damage it can really do if you're not paying attention. This chart just lays it all out there. That top blue line, that's your investment's growth in a perfect tax-free world. A beautiful thing. But that lower dotted line, that's the same portfolio after taxes for someone in a high tax bracket. You see that growing gap between the lines? That is a huge amount of your potential wealth just disappearing into thin air over time. And this really gets to the heart of it. Over a lifetime of investing, the total drag from taxes can absolutely dwarf everything else you pay. All the management fees, all the trading costs, all of it combined. If you let it go unmanaged, it is the #1 hurdle to growing your wealth. Okay, so that's the problem. It's a big one. But the good news is you can absolutely fight back. So let's move on and open up the Tax Smart Toolkit. These are your weapons against that tax bite. And here they are, your primary weapons. You've probably heard of most of them, things like your 401k at work, the traditional IRA, the Roth IRA. And then there's one you might not even think of as a retirement account, the Health Savings Account, or HSA. These 4 accounts are the building blocks of our entire strategy. Now, at the heart of this whole toolkit is a really fundamental choice, traditional versus Roth. It's pretty simple, actually. With a traditional 401k or IRA, you put in pre-tax money. That gives you a nice tax break right now. The catch? You pay taxes on that money when you pull it out in retirement. With a Roth, it's the exact opposite. You put in after-tax money, so no break today, but then all of your growth and all of your withdrawals in retirement are completely tax-free. It's the classic question. Do you want to pay taxes now or pay taxes later? So how do we actually use these tools? Because it's not just about picking one and sticking with it. It's about having a strategy. So let's get into it. A winning lifetime strategy. This is how you play the game. And there it is, the whole game plan, right here in one image. This is your game of life savings playbook. It shows you exactly how to move your money between these different accounts over your lifetime to slash your tax bill. Let's break it down. Okay, this 4-step plan is the core of everything. Step 1. During your peak earning years when you're in a high tax bracket, you load up those pre-tax accounts like a traditional 401k. Why? To get that big tax deduction when you need it most. Step 2, in any low tax years, maybe you're starting a business or taking some time off, that's when you contribute directly to a Roth. Step 3 is where the real magic happens, the conversion window. Sometime between, say, ages 55 and 70, you start systematically converting money from your pre-tax accounts over to a Roth, paying taxes at what you hope is a lower rate. And finally, step 4, the HSA. If you qualify for one, it's like a super Roth. Seriously, it has a triple tax advantage. Your contributions are tax deductible, the money grows tax-free, and your withdrawals are tax-free for medical expenses. It's amazing. So what's the payoff for all this maneuvering? What happens when you follow this playbook? Well, let's get to the best part. Unlocking tax-free wealth. The results can be, and I mean this, truly astonishing. How astonishing are we talking? How about $95 million? And no, that's not some hypothetical number. According to public filings, Max Levchin, the former chairman of Yelp, used a Roth IRA to hold on to some early-stage shares. The result? A potential gain of $95 million that, as long as he follows the rules, will never, ever be taxed. That is the unbelievable power of a Roth account. But listen, this strategy isn't just for tech billionaires. This analysis shows how it works for a more typical couple. Look at the bar on the far left, the never convert scenario. They end up with about $4.4 million. Not bad. But now look all the way to the right where they start doing those Roth conversions at age 55. They end up with over $5.2 million. That's more than $800,000 of extra spendable money just from being smart about when they paid their taxes. Okay, that's the long game. But let's bring this all back to an incredible opportunity that you can aim for right now. It's your turn to save, and we're going to talk about something called the Golden Zero. The Golden Zero is a real thing. It's written right into the U.S. tax code. It's a 0% tax rate on your long-term capital gains. Now, what's the catch? You have to keep your taxable income below a certain level. Now, that level changes, but the key word here is taxable income. That's what's left after you take all your deductions. This tax table shows you exactly what we're talking about. See that highlighted 0% bracket for long-term capital gains? That's your target. That's the zone you're aiming for. By using those pre-tax contributions to a 401k or a traditional IRA and taking other deductions, you can push your taxable income down into this zone. And what does that mean? It means you could sell investments from a regular brokerage account and pay absolutely nothing in federal taxes on the gains. Amazing, right? Ultimately, what this all comes down to is that taxes aren't just something that happens to you. They are a variable in your financial life that you can actively manage and control. Which really just leaves one final question for you. Are you playing the game of life savings to win?
You know, the world of investing, it's often sold to us like this big, exciting game. There are flashing lights, big promises, and the chance to score big. But what if the game is rigged? What if it's designed so that most people can't actually win? Today, we're going to look at some of those hidden rules and the financial landmines you absolutely need to know about. So, to really get our heads around this, I want to start with a story. It's not about money, but it perfectly captures the problem investors face. It's about a young space cadet, and he's about to take a test, not realizing the test itself is a trap.
He sits down at this console, and the instructions just start scrolling and scrolling. The rules are super long, they're complex, and they keep piling up, one after another, often contradicting the one before. It's just this wall of text, a classic case of paralysis by design.
Now this is where it gets interesting. Instead of trying to play, instead of jumping in and mashing buttons, he does something completely different. He just stops, he thinks, and he walks away from the whole thing. He's figured something out.
He goes right up to the officer and says, "Look, this game is impossible. You can't score any points." And the officer just says, "You passed." See, the real test wasn't about playing the game at all. It was about having the wisdom to realize it was unwinnable and then refusing to play.
And that, right there, brings us to the big question for our own money. Is Wall Street setting up these same kinds of unwinnable games for us? Let's take a look at a few really common examples.
Okay, first on our list is the promise of automated perfection, the robo-advisor. I mean, the sales pitch is fantastic, right? Just let a super smart algorithm handle everything for you. What could go wrong?
So the whole idea sounds great on paper. For a small annual fee, this computer will build and manage a diversified portfolio for you. But you have to ask yourself, does it really make sense to pay a robot a fee every single year for something you could probably do better yourself?
Well, here's the catch. A lot of these robos use pretty outdated strategies, so-called lazy portfolios, that don't really protect you when the market tanks. So you're paying this fee, maybe 1/4 to 0.5%, just to lose almost as much as the S&P 500. And sometimes the platform is really just a way for the company to push its own in-house funds on you. When you find out they're spending up to $1,000 just to get you as a customer, you realize the game is about gathering assets, not necessarily about getting you the best return.
All right, let's move on to our next potential landmine. This one has a fantastic name, smart beta funds. I mean, the name itself just makes you feel like you're getting an edge, that you're being, well, smart.
Now, this whole idea came about as a reaction to traditional index funds, which are market cap weighted. That just means the biggest companies have the biggest impact. The problem, people said, is that you can end up with too much money in a handful of giant stocks, these Icarus stocks that might be flying a little too close to the sun. So smart beta comes along and says, hey, we can fix that by weighting stocks differently, like giving every stock an equal slice of the pie.
But here's where the rubber meets the road. It is not pretty. While this popular smart beta fund did great in the years leading up to 2008, it delivered an absolute sucker punch when things got ugly. It actually fell more than the S&P 500 during the financial crisis. Suddenly, it didn't seem so smart after all.
And you know, this isn't some new 21st century problem. The journalist Walter Bagehot nailed it all the way back in 1879 when he said, "A great deal of stupid people have a great deal of stupid money. There have always been convincing stories that attract a lot of cash without a lot of critical thought. Smart beta is just the latest chapter in a very, very old book."
Okay, buckle up. We're now entering a corner of the financial world that looks a whole lot less like investing and a whole lot more like a high-stakes casino. Let's talk about currencies and leverage.
First, we've got currency trading, or Forex. It sounds incredibly sophisticated, right? You're not just buying a stock, you're betting on the entire economy of one country versus another. But here's the thing, it's a zero-sum game, period. For you to win, someone else has to lose. And as a small retail trader, you're playing against the house, the giant banks, with way more information than you.
And the numbers? Well, they speak for themselves. This is not a 50-50 coin flip. Look at these major brokerages. A huge majority, we're talking over 70% in some cases, of individual currency traders consistently lose money. The game is just not set up for them to win.
Next, we have some of the most dangerous and misunderstood products out there, inverse and leveraged ETFs. The promise is amazing. Make money when the market goes down. Get double or even triple the market's return. But there is a massive, fatal flaw hiding in the fine print.
That flaw is something called value decay. The best way to think about it is like trying to run up a down escalator. Because these funds reset their bets every single day, the math just grinds away at your money over time. And look at this insane example. An index lost 27%. The fund designed to go up when it went down also lost money. It lost 55%. And the 2x version was basically wiped out, down 93%. It is a textbook unwinnable game.
So let's be super clear about this. The takeaway here is simple. Stay away. These things are described as veritable financial landmines, and that's exactly what they are. They are not investment tools. They are gambles, and the odds are not in your favor.
Okay, so we've walked through a minefield of bad ideas. Overhyped robots, smart funds that aren't so smart, and casino-style products designed to lose. So, what's the actual winning move? How do you pass the test?
Well, the very first step is to do exactly what that space cadet did. Recognize the game for what it is. The financial world is a constant noise machine, promising you can turn $5,000 into $5 million. The first real winning move is to learn how to just tune it all out.
Let's just ground ourselves in a little bit of reality. This table shows what some of the smartest money on the planet, these huge university endowments, actually earned. Over 17 years, the average was 8.4%. Not 800%, 8.4. This is what real, successful, long-term investing looks like.
And that's really the core lesson here. The secret to winning isn't about finding some magic bullet or some secret product. It's simply having the wisdom to identify the games that are rigged against you and refusing to play them. It's about choosing to play a much simpler and much more effective game instead.
Here's a great little rule of thumb to remember. If a financial product seems way too complicated, or if the promises just seem too good to be true, it's almost guaranteed to be more profitable for the person selling it than it is for you. Complexity is almost always where fees and bad odds are hidden. The real winnable game is almost always the simplest one.
So I'll leave you with this one final thought to take with you. Just take a second and look at your own investments. Is there a complex product you're paying high fees on? Is there some speculative bet you keep making? What's one unwinnable game you can decide to just walk away from starting right now?
Welcome to The Explainer. Today, we're going to talk about a hidden threat to your retirement savings. It's a tax trap that can take a massive bite out of your Social Security benefits right when you least expect it. It's been quietly getting worse for decades, and today, we're going to show you exactly how to disarm it.
You know, this quote from Scott Burns really just says it all. What used to be a tax for only the wealthiest folks now hits almost a third of all retirees. And the reason why is actually kind of simple. The income levels that trigger this tax, they were set way back in the day and have never ever been adjusted for inflation. So as incomes have naturally gone up over the years, this net has been cast wider and wider and wider.
And they don't pull any punches when they describe it, calling it an explosive device. It's got a nickname, the tax torpedo. And it can suddenly make up to 85% of your Social Security benefits, yeah, that money you thought was safe, subject to federal income tax.
So what's really powering this thing? To get a handle on the threat, we first need to look at the engine that drives it, something called RMDs.
Okay, the keyword I really want you to focus on here is required. RMDs, or required minimum distributions, they are not optional. Once you hit retirement age, and that exact age has been shifting a bit, but it's in your early 70s, the government literally forces you to start taking money out of your pre-tax retirement accounts. Now, you don't have to spend it, but you do have to withdraw it, and, this is the kicker, you have to pay income tax on it.
And this chart really shows you how the problem just gets bigger over time. See, when you first start, you might only have to take out about 3.65% of your savings. But that percentage, it goes up every single year. By the time you're in your 90s, it's over 14%. The government is essentially forcing you to create more and more taxable income for yourself, whether you actually need the money or not.
Okay, that all sounds a little abstract, right? So let's make it real. We're going to walk through a case study of a pretty typical diligent saver. For today, we'll just call him Bill.
So let's meet Bill. He's the guy who did everything right. He worked hard, he saved consistently, and he built up this really nice nest egg of $1.35 million. But here's the critical detail you have to remember: where he saved it. All of this money is in pre-tax accounts, like a traditional 401k or an IRA.
On top of that, he's also going to get a pretty healthy Social Security check for $40,000 a year. He is looking at a very comfortable retirement. So far, so good, right?
But then retirement actually happens, and those RMDs we were just talking about, they kick in. For Bill, with his savings, his very first required withdrawal is almost $50,000. And since it's all coming from that pre-tax account, every single penny of it is treated as ordinary income for tax purposes that year.
Now this is where the fuse gets lit. The IRS has this special formula called provisional income that it uses to figure out if your Social Security gets taxed. And just look at the math. It takes half of your Social Security, plus pretty much all of your other income, including 100% of that RMD we just mentioned.
And here it is. This is the moment the torpedo strikes. If you follow the math, the IRS takes half of Bill's Social Security, that's 20 grand, and then adds his entire RMD of over $49,000. Suddenly, his provisional income is almost $70,000. Well, that is way over the $34,000 limit for a single person, so bam! The torpedo hits. 85% of his Social Security is now taxable income.
So what's the real-world damage here? It's a surprise tax bill of over $11,000. And that slashes Bill's annual spending money from what should have been almost $90,000 a year down to this, just over $77,000. That is a huge and probably unexpected hit to his retirement budget.
Okay, that was the scary part, but I promise there is some good news here. This torpedo can absolutely be diffused. There's an escape hatch, but you have to act before that RMD countdown clock runs out.
So what's the fix? Well, the core strategy is actually pretty simple on the surface. You need to move money from those taxable pre-tax accounts, like your 401k, into tax-free after-tax accounts, like a Roth IRA. The absolute key here is to do this bit by bit, over time, before those mandatory RMDs start and take the choice completely out of your hands.
So why is this such a game changer? Well, there are three really powerful reasons. First, Roth IRAs don't have RMDs for you, the original owner. You are back in control. Second, all your qualified withdrawals are 100% tax-free. And third, and this right here is the silver bullet, withdrawals from a Roth are completely invisible to that provisional income test. They just don't count.
Okay, so what does this actually look like when you put it into practice? Let's rewind the clock and go back to Bill, but let's see what would have happened if he'd used this strategy.
So let's play what if for a second. What if, during those final working years or in early retirement, Bill had strategically moved his savings over? He still needs the same amount of money to live on, but where that money comes from, well, that changes everything.
Okay, now look at the bottom half of this. Bill still gets his $40,000 in Social Security, and he still takes out that $49,000 he needs to live on. But because it's coming from his after-tax Roth account, it doesn't count as income. His provisional income is now just half his Social Security, only $20,000. That is well below the limit, and the result? 0% of his Social Security is taxed. His tax bill is zero.
When you put these two scenarios side by side, it's just night and day. With the tax torpedo, Bill has about $77,000 to spend. By planning ahead and diffusing it, he has his full income of almost $90,000. That's a difference of over $11,000 every single year.
Let's just boil it all down to one single number, 15%. Let that sink in for a second. By planning ahead, Bill gave himself a 15% raise in retirement. That's 15% more money for travel, for hobbies, for his family, every single year, for the rest of his life. That is the power of getting this right.
So, you've seen the problem, you've seen the solution. Now for the how. What can you actually do to apply this to your own retirement strategy?
All right, here's your action plan. Step 1, and I cannot stress this enough, you have to start early. This is a long-term play, not a last-minute fix. Second, while you're working, really try to max out those after-tax accounts like Roth IRAs and health savings accounts, HSAs, which also give you tax-free money in retirement. Third, you want to strategically convert money from pre-tax to after-tax, ideally in years when your income might be a little lower to keep the tax hit manageable. And finally, look, this stuff is complicated, so it's always a good idea to talk to a financial professional who can help you figure out the best moves for your specific situation.
And just to hammer home that last point, it's not just the IRS you have to think about. As you can see here, 13 states also have their own taxes on Social Security, and they all have different rules. It just adds another layer of complexity, making that personalized advice even more important.
So we'll leave you with this one final thought. It's a simple question, but the answer could literally change your retirement by 15% or more. Is your retirement plan truly torpedo-proof?
So you've spent a lifetime building your nest egg. Awesome. But now for the million-dollar question, or maybe the billion-dollar question, how do you actually draw from it so it lasts as long as you do? You know, getting this wrong is one of the biggest fears people have about retirement, so let's get in there and figure out how to get it right.
The whole challenge of retirement is this delicate balancing act. If you withdraw too much, you could run out of money way too soon. But if you withdraw too little, you might be pinching pennies for no reason, and you miss out on the freedom you worked so incredibly hard for.
And that brings us right to the heart of the puzzle, doesn't it? What is that magic number? What percentage can you safely pull out year after year and sleep well at night? Well, for decades, there's been one very famous answer. And that answer, the one you probably heard of, is the famous 4% rule. It's been the bedrock of retirement planning for, a whole generation? But what is it really, and more importantly, does it still hold up today?
The rule itself is pretty simple on the surface. In your very first year of retirement, you take out 4% of your total portfolio. Simple enough. After that, you just take out that same dollar amount, but you give it a little bump each year to account for inflation. It sounds super straightforward, but its simplicity is kind of deceiving.
Now here's what you absolutely have to understand: why this rule was even created in the first place. Back in 1994, it was designed to be ultra safe. I mean, it was built to survive a repeat of the Great Depression. For someone looking at a 30-year retirement, it was literally designed for a very specific financial apocalypse kind of scenario.
Okay, and that leads to a really important question. If the 4% rule was designed for the absolute worst case, what happens in all the other cases? You know, the not worst cases. Is it possible that being safe is actually costing you a better retirement?
Well, check out this staggering statistic from financial planning guru Michael Kitces. In over 2/3 of historical scenarios, retirees who followed the 4% rule didn't just make their money last. They finished 30 years with more than double what they started with. Let that sink in. Double.
This really makes you stop and ask a tough question. By sticking so rigidly to this super cautious rule, are you basically forcing yourself to live on less than you have to? Also, you can end up with this huge pile of money you never actually got to enjoy?
Fortunately, there's a much more sophisticated way to think about this now. Instead of some one-size-fits-all rule, we can use a framework that's based on 5 key personal factors to find your specific safe withdrawal rate, or SWR for short.
Okay, the first key is your time horizon. In other words, how long do you need your money to last? It's pretty obvious, right? A 65-year-old planning for 25 years is playing a totally different game than a 55-year-old who needs their money to last for 40 years. This is all about making sure your portfolio has staying power. And as you can see on this roadmap, the math changes quite a bit based on that timeline. If you only need the money for, say, 20 years, a 5% rate might be totally fine. But if you're retiring early and need it for a good 40 years, you've got to be more conservative, maybe something closer to 3.5%. The standard 30-year plan, that keeps you right at that 4% baseline.
All right, next up is diversification. How your money is invested has a huge impact on what you can safely take out. And we're not just talking about a simple mix of stocks and bonds here.
The research shows that portfolios with really high diversification, we're talking including global assets, real estate through what are called REITs, and even commodities, can support higher withdrawal rates. A simple portfolio that's just US stocks and bonds, it's just not as robust, so you need a more conservative rate.
This one is so simple but so powerful. Fees matter. A lot. Every single dollar you pay to a fund manager or an advisor is a dollar that isn't working for you, and it directly chips away at your sustainable withdrawal rate. Now, the impact isn't exactly one for one. The study suggests your safe withdrawal rate drops by about 0.35% for every 1% you pay in fees. The takeaway is crystal clear, though. Keeping your costs low is one of the most direct ways you can spend more of your own money. Next, we have to talk about taxes. Because, it's not about how much you withdraw, it's about how much you actually get to keep.
And the type of account your savings are in, it's a total game changer.
The difference is pretty stark. If all your money is sitting in a tax-free account like a Roth IRA, your withdrawal rate is your spendable income. Boom, done. But if you're paying, let's say, a 12% tax on your withdrawals, that directly lowers how much you can actually spend.
And the final key, well, this one is all about you. It's about your personal comfort level with risk. And this isn't just about watching the market go up and down. It's also about how flexible you can be as a spender.
So think about it. Are you comfortable with having more of your money in stocks, maybe 75%? That can support a higher rate. And are you mentally okay with the idea of maybe cutting your spending for a year or two if the market really tanks? If the answer is yes, you can justify starting with an even higher initial rate.
So this is the fun part. We can take these 5 rules and we can combine them to move away from that generic 4% baseline to a withdrawal rate that is tailored specifically for you and your life.
Let's just walk through the typical choice column on this checklist together. We start with that 4% baseline. A 30-year lifespan? That adds 0. But high diversification? That adds a full 1%. Low fees and tax-free accounts? Let's say those add 0 for now. And then having an aggressive portfolio with spending flexibility? That adds another 1%. You do that simple math and bam! You're at a 6% initial safe withdrawal rate. That's a full 50% higher than the old rule.
And here's some really reassuring context for all this. While we plan for inflation, the real-world data shows that our actual spending often goes down as we get older. Just look at this. People over 75 spend way less on big things like housing and transportation than they did back in their 40s and 50s. This creates a natural safety net in your later years.
So the ultimate takeaway here is this. The 4% rule was never meant to be some ironclad law. It's a starting point, a baseline. By really thinking about your personal timeline, your diversification, your fees, your taxes, and your own risk tolerance, you can move from a generic rule to a plan that's truly tailored to you. The question isn't what some study from decades ago said. The real question is, what's the right number for your life?
All right, let's get right into it. Today, we're talking about a strategy for a position that, let's be honest, is a pretty great one to be in. What to do when you've already won the investing game. This is all about the endgame portfolio, a game plan that isn't about getting rich, but about staying rich.
And you know, that really is the million-dollar question, isn't it? If you've worked hard, saved up, and now you've got more money than you'll ever really need, well, the old rules of aggressive, risky growth just might not make sense anymore. It's time for a whole new way of thinking.
So that's what this is all about. Think of this as a guide for that exact moment, the point where you've reached your financial destination. Now you need a new map. One that's all about protecting what you've built for the long, long haul.
Exactly. I mean, if you've built up a nice nest egg, let's say it's $5 million, your number one job isn't trying to turn it into $10 million. It's making absolutely sure that money lasts you for the rest of your life. The whole game just shifts. It goes from high risk, high reward to security, stability, and, peace of mind.
So how do you do it? Well, that brings us to the core idea here, the end game portfolio. And it's a surprisingly simple plan that balances that need for safety with just enough growth to keep you ahead. Let's take a look at how it actually works.
The breakdown is brilliantly simple. A huge, enormous 80% chunk of your money goes into bond exchange traded funds, or ETFs, which are designed to kick off a nice, predictable stream of income. The other 20%? That stays in a growth-focused portfolio, something to make sure your buying power keeps growing and beating inflation over time. Now, this is where it gets really interesting. Take a look at this chart. The gray line, that's the endgame portfolio. The orange line is the S&P 500. See that absolutely massive cliff dive the orange line takes around 2008? That was the big financial crisis. The endgame portfolio, it barely even flinched. That is the smooth ride we are talking about. Okay, so let's put a real number on that. During the absolute worst of the 2007-2009 crash, the biggest drop the endgame portfolio had was just 12.4%. Now, that's a dip, sure, but it's manageable. It's not the kind of thing that keeps you up at night.
Now compare that to the S&P 500. In that same period, it lost a staggering 51% of its value. Half. Imagine watching half your life savings just evaporate. The difference between those two numbers is the entire reason this portfolio even exists, to avoid that kind of gut-wrenching, terrifying volatility when you really don't have to take that risk anymore.
So you're probably wondering, how does this portfolio pull off that kind of stability? It's not just about buying any old bonds. The secret sauce, the special ingredient, is a particular kind of investment called a defined maturity bond ETF. Let's break that down. Okay, so think of a defined maturity ETF, or DM ETF, like this. It's a big basket holding hundreds of different bonds, but they all have the same expiration date. So you might buy, say, a December 2028 ETF. And here's the magic part. On that specific date in 2028, the fund closes up shop and you get your original investment, your principal, paid back to you. This is a total game changer.
Right, but wait a minute. This is probably the #1 question on your mind, and it's a really good one. We've all heard this, right? When the Federal Reserve raises interest rates, the price of older existing bonds goes down. So, how does this portfolio deal with that pretty significant risk?
This seesaw analogy is really the perfect way to picture it. Imagine you own a bond that pays 3% interest. Suddenly, new bonds are being sold that pay more, maybe 3.09%. Well, why would anyone pay full price for your old 3% bond? They wouldn't. To make it attractive, the market price of your bond has to drop. It's just simple supply and demand. And this is where that crucial difference comes in. With a regular, ordinary bond fund, one that just goes on forever and never matures, you're totally exposed to those price drops. But with a defined maturity ETF, you have a kind of superpower. You can just ignore all the day-to-day price swings. You just hold on until that maturity date when you're scheduled to get your principal back.
So to make this work even better, and to create a really steady flow of cash, you use a super clever technique called a bond ladder. This is how you actually structure that big 80% chunk of your portfolio. Check this out. Instead of dumping all your money into one single DM ETF, you buy a bunch of them, and each one matures in a different year. So you'd have one for 2027, another for 2028, one for 2029, and so on. This way, a piece of your portfolio is maturing and turning back into cash every single year, which you can then spend or, reinvest somewhere else.
Now, the source material here recommends what it calls a gradual switchover. It's a pretty smart idea. Instead of selling 80% of your stocks all at once, which could be a huge tax hit, you just convert a little bit of your portfolio, about 11.5%, into a new rung on that bond ladder each year for 7 years. This lets you lock in those better, higher interest rates that you usually get with longer-term bonds.
Okay, we've got to talk about something really important here. A word of warning. When you start looking at bonds, it is so tempting to reach for the ones offering the highest interest rates. You'll see them called high yield or even junk bonds. And this, especially for an endgame investor, is a dangerous trap.
I mean, this chart tells you everything you need to know. Look at the green and blue lines at the top. Those are high-quality investment-grade bonds. Notice how their default rates basically just hum along near zero, even during the Great Recession? Now, look at the orange and red lines for the lower-rated junk bonds. They just went vertical.
Let's look at the actual numbers from back then. In 2009, the good stuff, investment-grade bonds rated A or BBB, had default rates of less than 0.5%. Tiny. Even the highest tier of junk bonds only saw about a 1% default rate. But as you go down that quality ladder, oh boy, the numbers get scary fast.
And then you get to the bottom of the barrel, the riskiest bonds out there, the ones rated CCC, CC, or C. Nearly half of them defaulted in 2009. Think about that. It's almost a 50-50 chance the company just fails to pay you back. That's not an investment. It's a coin flip.
And that's really the bottom line, isn't it? The entire point of the endgame portfolio is to get rid of risk, not to pile more on. When your #1 goal is just preserving your capital, chasing an extra % or 2 of yield by buying really risky bonds, it's just a fool's errand. It goes against the entire philosophy.
The author who came up with this whole strategy actually sums it all up with this little rhyme. It's a pretty memorable way to get the core idea across. Once you've built up enough wealth, you can just opt out. You can choose not to suffer through the stomach-churning volatility, the stock's pain that comes with traditional investing.
And that kind of leaves us with one final thing to think about. A strategy like this, it's not just about the numbers on your screen. It's about being able to sleep soundly at night, to not have to check the market every 5 minutes, to just live your life without that constant financial anxiety hanging over you. So the real question is, what is that peace of mind really worth to you?
You've probably heard the advice 1,000 times, right? If you want higher returns, you've got to take on more risk. It's like the golden rule of investing. But what if that rule is a lie? What if it's a zombie idea, an old theory that should be dead and buried, but just keeps shambling on, eating away at your portfolio? Well, in this explainer, we're going to put those zombies to rest for good and uncover what modern finance tells us we should really be doing. And you know, the legendary investor George Soros gets right to the heart of it. He completely challenges that core belief that the market is this all-knowing, super efficient thing. This is the perfect place for us to start because we are about to take a really hard look at the foundational truths of investing and see which ones are, well, actually just myths. So what exactly are we fighting here? Zombie ideas. Yeah, these are the financial myths that just keep whispering in our ear, influencing our decisions, even though the theories they're built on were debunked decades ago. Our goal here is pretty simple. We're going to give you the tools to spot these zombies and finally put them out of their misery. So, how do these ideas become zombies in the first place? Well, just like scientific facts, financial theories actually have a half-life. What was once considered gospel becomes a relic as new data and better evidence comes along. The big problem is Wall Street was basically built on a lot of these now defunct zombie ideas. And wow, this timeline really says it all. Just look at the foundational pillars from the 50s and 60s. Modern portfolio theory, CAPM. See what it says? Not useful. They were rebutted decades ago. It's kind of crazy, right? Yet these zombie ideas are still influencing how millions of people, maybe even you, invest their money today. All right, let's get to it. It's time to roll up our sleeves and see exactly why these old gods of finance totally crumbled under the weight of real-world evidence. Okay, first up is the big one, modern portfolio theory, or MPT. This goes all the way back to 1952, and its core idea was honestly revolutionary at the time. Harry Markowitz showed mathematically that by combining different risky assets, you could actually lower your portfolio's overall risk. I mean, what a concept. It totally changed finance forever. But does it actually work? And here it is. This is the knockout punch for MPT. When someone asked its creator, a Nobel laureate by the way, how he invests his own money, Harry Markowitz admitted he just uses a simple 50-50 split of stocks and bonds. He doesn't even use his own complex theory. So you have to ask yourself, if the guy who invented it doesn't trust it with his own cash, why on earth should we? Now this is the beautiful promise of MPT, all visualized. It's called the efficient frontier. This elegant curve is supposed to show you all the optimal portfolios, the ones that give you the absolute highest return for whatever level of risk you're willing to take. In theory, you just pick a spot on this line and bam, you're golden. It looks perfect, doesn't it? Yeah, but here's reality. This slide shows what would have happened if you actually tried to use that pretty curve in the real world. In the 1930s, or even the 2000s, following the model would have been an absolute catastrophe. For entire decades, stocks were a huge drag, turning that elegant theory into a painful downward plunge. The theory just completely breaks down when it meets reality. You know, investment manager William Bernstein just sums it up perfectly. Using last year's data to predict next year's perfect portfolio is like chasing a ghost. The bottom line is, the efficient frontier is a beautiful, elegant, and dangerous myth. All right, our next zombie is another big one, the capital asset pricing model, or KPM. Now, this is the theory that gave us that famous mantra, high risk equals high return. It claimed the only way to earn more was to take on more market risk, and it tried to boil all that risk down to a single number called beta, which is basically just how much a stock zigs and zags compared to the overall market. But then the research came in. After crunching decades of data, the brilliant economist Eugene Fama declared that beta is, and I'm quoting here, dead. One financial advisor said this was like the Pope coming out and announcing there is no God. I mean, just like that, the entire foundation of the risk equals reward idea was demolished by the evidence. Okay, so the old theories are dead. Where do we go from here? We need a better foundation. And you know what? It all starts with measuring risk the right way. This is the key question we have to ask ourselves. The old models defined risk as simple volatility, the ups and the downs. But is that really what we as investors actually care about? I mean, is a big up day really risky? Or are we a little more concerned about something else? This slide shows just how totally wrong that old ruler is. Look at this. We have 3 portfolios. One rises nice and smooth, another crashes 55%, and the third goes into a 78% depression. And yet, The most common risk measure out there, the Sharpe ratio, gives all three the exact same score. It is completely blind to the agonizing journey of the investor in those bottom two. It's not just useless, it's dangerously misleading. We need a better ruler. And here's one: the Martin ratio. It completely ignores simple up and down volatility and instead measures what actually matters to us: the depth and the duration of our losses. It's literally designed to quantify the pain of a market downturn, which is a far, far more useful way to think about risk. So with a better way to measure risk in our toolbox, let's take a look at how markets really behave. The old theories assumed this neat, tidy, predictable world. The reality, well, it's a whole lot wilder. See, old theories assumed market returns fit into this nice, symmetrical bell curve, like you see in a textbook, with about an equal number of winners and losers. But the reality, it's what's called a free market distribution. It's totally lopsided. You get a few massive winners that drag the average way up, and then a huge number of losers and just mediocre performers. And this chart just illustrates that lopsided reality perfectly. Over a 23-year period, 64% of all stocks underperformed the basic index. I mean, let that sink in. Just picking stocks at random is a losing game almost 2/3 of the time. The market's gains aren't spread out. They're driven by a tiny handful of superstar stocks. And here's another reality check, this one from the mathematician Benoit Mandelbrot. It's called volatility clustering. While we can't predict if the market is going to go up or down tomorrow, we can predict when it's likely to be dangerous. The data clearly shows that wild days, both up and down, are not random. They cluster together, almost always during market corrections. This is a huge, huge clue for managing risk. So let's recap. The old theories are broken. Real risk is about drawdowns, not just volatility. And markets are lopsided and tend to cluster their risk. So what do? We need a new model, one that actually accepts these realities and adapts to them. This isn't about setting and forgetting, it's about being responsive. I absolutely love this analogy. The old way of investing, using these static allocations based on 50 years of data, it's like using a farmer's almanac to predict today's weather. It's a vague historical guess. The new dynamic model is like using Doppler radar. It looks at the current conditions to make adjustments. It lets you see the storm forming right now so you can seek shelter, instead of just hoping for the best based on what happened last summer. Let's put it all together. This table really summarizes the entire shift in thinking. The 20th century assumed a neat bell curve and that risk was static. The 21st century model accepts reality, a lopsided market where risk comes in waves, and where factors like momentum, the tendency of winning assets to keep winning, can actually give us an edge. It is a complete paradigm shift from a passive, hope-based approach to an active, evidence-based one. And that brings us to our final and really the most critical question. After seeing how the foundational theories of the last century have been completely overturned by evidence, it's worth asking yourself, are these debunked zombie ideas still quietly managing your money? It might be time to check. Let's imagine for a second that your investment portfolio is a crime scene. It's been murdered. The returns are dead. So the big question is, who did it? Yeah, think about it. The scene of the crime, that's your brokerage account. The evidence, well, those returns are definitely not what you'd hoped for. So who's the culprit here? Okay, you ready for this? The killer is you. I know, it's a huge plot twist. But in this mystery, the call is absolutely coming from inside the house. You're the one holding the smoking gun. But hey, before you get too worried, you're not alone in this, not by a long shot. Turns out, most of us are our own worst enemies when it comes to investing. The good news, though, is that once we figure out how and why this keeps happening, we can actually fix it. So let's put on our detective hats and investigate this thing. All right. Every good detective story has its lineup of the usual suspects, right? Well, in our case, the suspects are these really common, totally human behaviors that just sabotage our best efforts. Let's haul them in for questioning. Suspect number one, this is the big one, the classic emotional roller coaster. You see the market soaring, everyone's getting rich, and you jump in, right? But the second things get a little shaky and scary, you panic and sell. This is pretty much the fastest way to absolutely torch your returns. Okay, next up in the lineup, good old-fashioned overconfidence. This is that little voice in your head that whispers, hey, you're smarter than these guys. You can find that one secret formula that all those thousands of Wall Street professionals somehow just missed. It feels good to think that, right? But man, is it a dangerous fantasy. And this next suspect is basically overconfidence's partner in crime. It's that feeling when you just know a company is going to be huge because you love their product. You convince yourself that your personal opinion is enough to pick winning stocks. But let's be real, the odds are they're not in your favor. Here, and then we have this character, the slick, well-dressed expert. You know the type. They're so confident, we fall into this trap of paying them huge fees for results that are often pretty terrible. Just remember, a fancy suit and a confident voice don't actually equal good advice. All right, let's talk about the gambler, the lottery ticket mindset. This is when you just crank the risk dial all the way up, thinking that's the only path to those massive, life-changing gains. But what usually happens? You just end up with massive, life-changing losses instead.
But here's the crazy part. The complete opposite mistake can be just as deadly. You get burned by taking on too much risk, so you do a total 180. You pull everything out, stuff it in a savings account, and let it sit there earning basically nothing. Now, fear is the killer, and it's a silent one, letting inflation just eat away at your money year after year.
Okay, we've just grilled a whole lineup of our own worst instincts. It's a little grim, I get it, but here comes the twist in our little murder mystery. The exact same flaws that make us bad investors, the overconfidence, the emotions, the love for a good story, well, guess what? The so-called experts have them too. And that, believe it or not, gives us a really surprising edge. And this isn't just a hunch. It's backed by some amazing research from a Wharton professor named Philip Tetlock. In his work on what he calls super forecasting, he found something wild. With just a little bit of training, regular people, amateurs, got incredibly good at making predictions. But here's the real kicker. Their confidence was accurately tuned. What does that mean? It means they knew what they didn't know. That's the total opposite of that overconfident suspect we just talked about. And check this out. The best teams of these trained amateurs were a mind-blowing 35 to 60% better at forecasting than the professional experts. I mean, that's not just a little better. That is a massive difference. That's an advantage you can actually use. So let's just lay it all out, side by side. On one side, you've got the experts. They're prone to overconfidence. They use these super complex schemes that often just don't work. And on the other side, you've got trained amateurs. They're way more realistic about what they know, and they get way better results using simple training. This amateur advantage, it is absolutely real.
Okay, so this is the million-dollar question, right? How do we actually use this amateur advantage to, stop murdering our own portfolios? Well, the answer isn't some new, complicated, secret formula. It's actually something beautifully simple and powerful, a mechanical solution.
So what the heck is mechanical investing? It's really just about discipline. It means you follow a system, a set of rules you decide on beforehand, so you can take the biggest threat to your money right out of the equation. And what's that threat? Your own opinions and your own emotions. And this system does not need to be complicated. Seriously, it can be as simple as setting up an automatic investment every single month into a basic, low-cost index fund. That's it. You just let it run, no matter what the crazy headlines are saying. So in practice, what does this look like? It really boils down to 3 simple rules. Step 1, tune out all the noise from the market experts. Step 2, and yeah, this is the toughest one, you have to tune out your own opinions, your own gut feelings. And step 3, you just follow the system, faithfully, consistently, when things are great and when things are scary. And that's it. That's the key to solving this whole mystery. You don't need some ridiculously complex scheme or a secret password to do well. In fact, when it comes to investing, complexity is usually your enemy. The simpler the plan, the easier it is to actually stick with it. And that is what leads to success in the long run. So that leaves us with one final and really critical question, a question you have to ask yourself. Now that you've seen all the evidence, now that we've identified the culprit, do you have what it takes to fire yourself from the job of managing your portfolio's emotions? Can you actually learn to trust a simple system more than your own gut? Because honestly, the answer to that question is going to decide everything.
Ever felt like your portfolio was kind of working against you? Well, today we're going to dig into 2 really common traps that can silently drain your returns. But the good news is there's a super simple, really powerful hack that fixes both of them. I mean, if you manage your own investments, does this ring a bell? You do the smart thing. You sell something to get a tax loss, and the IRS just says nope. Or maybe you open up your 401k statement, look at the fund options, and just think, really? This is it?
All right, here's the game plan for today. We're going to start with those headaches, the wash sale rule, and those not-so-great 401ks. Then we'll get right to the solution, substitution tables. We'll even show you how to find your own alternatives so you can take back control. So let's dive right in.
Okay, first things first, let's talk about the problems. I mean, these are two specific issues that can cost you real money. We're talking taxes and just holding your portfolio back.
So let's kick things off with the super confusing IRS rule that trips up even the most seasoned investors. It's called the wash sale rule. And believe me, it can totally wipe out one of the best tools you have for managing your investment taxes.
So, what on earth does that actually mean? Let's break it down. Imagine you sell, say, an S&P 500 index fund at a loss, because you want that sweet tax deduction, right? But then you immediately turn around and buy another S&P 500 index fund within 30 days. Well, the IRS basically looks at that and goes, no way, you can't claim that loss. Because from their point of view, you were never really out of the market.
Okay, so this is how the trap gets sprung. Step 1, you sell to lock in that loss, which is awesome because it can offset other gains or even your income. Step 2, you're a smart investor. You want to stay in the market, so you buy something substantially identical right away. And then, step 3, wham, the IRS just shuts it down. No deduction for you.
All right, the second big headache. This one hits home for a lot of us. You're doing everything right, trying to build a solid, diversified portfolio, but your 401k plan just isn't playing ball.
Does any of this sound familiar? You've done all the research, you know exactly which low-cost ETF you want, but it's just not in your plan. Instead, you're stuck with this tiny list of mutual funds, and they're all loaded with these crazy high fees that are just chewing up your returns year after year. So you're forced to pick the least bad option, right? And that is absolutely no way to build real wealth.
Okay, so we have these two big problems. What's the solution? Is there an elegant fix for both the wash sale rule and a crummy 401k? Well, it's actually simpler than you might think. It really just comes down to knowing your alternatives.
And that's where these things come in. Think of them as the ultimate investor cheat sheet. They're built to help you find a fund that tracks the exact same thing you want, like, US stocks or international bonds, but is just different enough so it's not substantially identical. And this is key because the IRS is, let's be honest, super vague about what that actually means. So this strategy is really your safest bet.
Okay, let's look at a real example of how this works. Let's say you want to sell VTI, that's an all-US stocks ETF, to get that tax loss. You just look at this table, and boom, you've got options you can buy right away. You could grab a Vanguard mutual fund or a similar ETF from a different company like IWV. The point is, you stay invested in US stocks, but you totally avoid the wash sale rule. Simple.
And you know what? These tables get even more powerful when you have a more diversified portfolio. So let's say you need to swap out an emerging market ETF, something like VWO. The table points you right to a great alternative, like IMG. Need a replacement for a gold fund? Yep, it's got options for that too. It's basically a quick reference guide for pretty much any part of your portfolio.
So using these tables is super easy. It's a really straightforward process. First, you just find the fund or the asset class you're looking for in that left column. Then you just look to the right to see what's available, whether it's mutual funds or other ETFs. And of course, you always want to keep an eye on those fees. It's just a really fast way to find a good substitute.
Okay, but what happens if your 401k plan is so limited that it offers none of the funds on these cheat sheets? Don't panic. You're not out of luck. It just means you got to do a little bit of your own detective work. And lucky for us, there are some awesome free online tools that can help. So there's ETFscreen.com. That'll help you find funds that are highly correlated, which just means their prices tend to move in the same direction. And then there's ETFdb.com. This one lets you search by category, which is perfect if you're just like, look, I just need any decent low-cost international stock fund.
But, and this is a big but, there is a critical warning you have to remember. A high correlation doesn't ensure that two funds will have the same performance. I'll say that again. Just because they move together, it absolutely does not mean they're going to give you the same results.
Let's break that down because it's really important. Think of it this way. Correlation, that's just about the direction the funds move. Do they go up and down together?
Performance, on the other hand, is about the magnitude of that move. It's about how much money you actually made or lost, the real return. So yeah, correlation is a good starting point for your search, but performance, that's the ultimate test. That's what actually matters.
So before you pull the trigger on any substitute fund, you absolutely have to do this one last step. Just pull up a free charting tool online, there are tons of them, and compare the two funds side by side over the longest period you possibly can. Honestly, this is the only way you're going to see the real-world difference in their returns and know for sure if that substitute is a good fit for your portfolio.
All right, let's bring this all home. Let's talk about the key takeaways, the action plan you can use to take control of your portfolio, like right now.
Okay, here it is, your 3-step action plan. Number 1, to dodge a wash sale, you sell for a loss, then immediately buy one of the substitutes from those tables for the same asset class. Number 2, to fix that bad 401k, you use those same tables and tools to hunt down the best lowest cost option that's actually available in your plan. And number 3, if you're searching on your own, always prioritize similar long-term performance. Trust the charts, not just a correlation number.
You know, at the end of the day, all of these techniques are really about one thing: empowerment. They give you the power to make smarter, more tax-efficient choices and to finally break free from the chains of a bad 401k. When you get strategic about your fund choices, you can sidestep these expensive traps and really take control of your financial future. So the question is, what simple change are you going to make to unlock your portfolio's potential?
Today, we're diving into the toolkit for the Muscular Portfolios strategy. You know, this is a really powerful way to invest that rotates into the strongest assets to try and maximize your gains. And you know what the best part is? It's completely transparent. That gives you the power to be a truly self-reliant investor. Think of this as your personal guide to finding the top-performing ETFs, all by yourself.
So picture this. It's the first of the month, time to rebalance. You head over to your favorite website for the latest signals, and boom, the site is down. Just gone. All of a sudden, your whole strategy is just sitting there, on hold. You're stuck. So what do? Well, here's the good news. Unlike a lot of strategies that use some kind of secret black box formula, this one is totally open. It's based purely on ETF prices that are out there for everyone to see. And that means you already have all the power you need to find the signals on your own. And don't worry, we're going to walk through exactly how to do it. So here's our game plan. First, we'll talk about why having a plan B is so critical. Then we'll get into 2 awesome and free methods using ETFscreen.com and stockcharts.com. And finally, we'll wrap it all up with what this really means for you, what it means to be a truly empowered investor. Okay, so let's get into this whole Plan B thing. Relying on just one website, even if it's a great one, is risky. It's a single point of failure in your whole investment plan. So having a manual method isn't just a backup. It's really a crucial part of understanding and truly owning your investment process. To get this essential backup plan in place, we're going to check out 2 fantastic online tools. And the best part? They're totally free. You're not going to need any pricey software or special subscriptions. These sites give you everything you need to figure out the ETF rankings from the ground up. All right, let's kick things off with our first method, using a really powerful all-in-one tool called ETFscreen.com. This website is just excellent for screening, analyzing, and ranking exchange-traded funds with just a few clicks. So first things first, you'll head over to etfscreener.com and sign up for a free account. Once you're in, just look for the My Pages menu, pull that down, and click on New Portfolio. Next up, you're going to see a box that says Enter Symbols. This is where you'll type or paste in the ticker symbols for all the ETFs in the portfolio you're following, whether that's the Mama Bear or the bigger, more diversified Papa Bear. See? Right there under the My Pages dropdown, you'll find the New Portfolio option. And from there, that Enter Symbols box is right where you need it to be. It's a nice, clean place to start. Now, this next part is the most important step. Define view/layout. This is where you tell the screener exactly how to rank the funds. You're going to click that last box in the row to set the total return period. Honestly, this is the secret sauce to the whole thing. Okay, so listen up. For the Mama Bear portfolio, you'll want to select total return 5 months. Easy enough? For the Papa Bear, it's a bit more complex. You'll need to find the option that averages the 3, 6, and 12-month total returns. Oh, and here's a pro tip. Make sure you set the sort order to descending. That way, the best performers just pop right to the top of the list. And finally, the easy part. Just give your portfolio a name, like Mama Bear, and hit that Save Changes button.
And just like that, you've built your own custom screener that's going to do all the heavy lifting for you every single month.
So you see, that all-important drop-down for the return period is right there in the layout section. After that, you just name it and click Save. It really is a pretty simple 4-step process to get everything set up and ready to go.
And that's pretty much it. From now on, you just log in, go to My Pages, click on your saved portfolio, and the website will instantly give you the ranked list. All you have to do is hold the top 3 ETFs on that list for the month. Simple as that.
Okay, so you've got the all-in-one tool down. Now let's look at another way to do this. A quicker, more visual alternative that's really great for a quick check. Stockcharts.com. For the Mama Bear portfolio, this process is super straightforward. We'll give you a URL that preloads all the ETFs for you. All you have to do is set the date range to 106 trading days. That's about 5 months. And then switch the view to a histogram chart. The top 3 performers will jump right out at you.
See, that date range field is where you'll type 106. The button to switch over to the histogram view is right next to it. Once you click that, you're literally just looking for the 3 tallest bars. Those are your winners for the period. Now for the Papa Bear portfolio, there's a tiny little wrinkle. This one uses 13 ETFs for more diversification, but stock charts can only handle 10 symbols on its performance charts at one time. So we just have to do this in 2 batches. It's not hard, just a couple of extra steps. Okay, for part 1, you'll use a specific URL that loads up the first 9 ETFs. Then you're going to check the performance for 3 different timeframes: 64 days for the 3-month return, 127 for the 6-month, and 253 for the 12-month. The key here is to just jot down the return percentage for each ETF at each of those 3 settings. Then you'll use a second URL for those last 4 ETFs and do the exact same thing. Record the 3, 6, and 12-month returns. Once you've got all your numbers, you just calculate the average of those 3 returns for each of the 13 ETFs. The 3 with the highest average, those are the ones you hold. Yeah, it's a bit more manual work, but totally doable. So we've walked through 2 really practical ways to get this done. But this isn't just about the technical steps. This is about a fundamental shift in how you think about your investments. This is really about empowerment.
This quote really gets to the heart of it all. Because the strategy is fully disclosed and just based on public price data, you are never, ever locked into a single source of information. The whole system is completely open for you to check and run yourself.
Think about it. You're not just a passive follower of signals from some website that could vanish tomorrow. You now have the actual toolkit to generate those signals yourself. You get the how and the why behind the rankings. Your investment strategy is now truly 100% in your hands. So now that you have this toolkit, now that you have the knowledge to be your own portfolio analyst, how are you going to use this power to take control of your own financial future?
When it comes to investing, the word lazy sounds pretty good, doesn't it? I mean, the whole idea is you just set up your portfolio, kick back, and let it do all the work. But is it really that simple? Today, we're diving into the big appeal and the kind of hidden dangers of lazy investing.
So let's just get right to it with the biggest question of all. Is being lazy really the smartest path to building wealth? The hands-off approach sounds like a dream, but does it hold up when the market gets rough? Let's dig in and find out.
So what exactly is a lazy portfolio? Well, at its heart, it's a set-it-and-forget-it deal. You just pick a mix of different things, stocks, bonds, maybe some real estate, and you lock in the percentages. Then maybe once a year, you just tweak it back to that original recipe. That's it. No checking the market every 5 minutes, no stressing out.
And you can totally see why this is so popular. I mean, first off, these allocations are often cooked up by financial gurus, so you feel like you're in good hands. They're also automatically diversified, which is great. And maybe the best part? They're super simple to set up and manage. It really does sound like the perfect stress-free solution. But here's the thing, lazy doesn't mean one size fits all. Not at all. There are actually a ton of different flavors of this strategy out there. So let's take a quick tour and see what these portfolios actually look like in the wild. And wow, the variety is pretty wild. What you're seeing here are 10 different lazy portfolios from some really well-known financial minds. For instance, you've got William Bernstein's super cautious cowards portfolio, and then way over on the other end of the spectrum, you have David Swenson's much more aggressive approach. It just goes to show you, everyone's got a slightly different idea of what the perfect hands-off mix should be.
Let's zoom in on one of these to make it more real. This is that Coward's Portfolio from William Bernstein. It's a pretty simple recipe. about 45% in U.S. stocks and real estate, 15% in stocks from outside the U.S., and then a really solid 40% chunk in safer short-term bonds. The name really says it all, right? It's designed to be cautious.
And of course, other experts put their own spin on it. Take David Swenson, the guy who famously managed Yale's massive endowment. He built his portfolio with a super long-term view, thinking in decades, not years. So he included things like long-term government bonds to ride out big economic shifts. It just proves that even inside this lazy world, there's a lot of debate about the right way to do it.
So it all sounds pretty smart, doesn't it? It's simple, it's diversified, it's got the stamp of approval from experts, which kind of makes you wonder, what's the catch? There's gotta be a catch, right? What's the hidden risk here?
And this is where the story really takes a turn. This brings us to the main critique from the source material we're looking at. The potential problem is so big that the author gives these strategies a pretty intense name, downer portfolios. And here's the gut punch. The argument is that these portfolios can actually give you the worst of both worlds. You don't quite get the amazing highs when the market is booming, but then you still get crushed almost as badly as everyone else when the market tanks.
Okay, so let's be clear about what a downer portfolio is. The source defines it as any strategy that tends to lose 30% or more of its value every few years. But look, the real danger here isn't just the number. It's the psychological gut punch. Seeing a loss that huge makes people panic. They sell everything at the absolute worst possible moment, and that turns a temporary dip into a permanent, life-altering loss. And yeah, this picture pretty much says it all, doesn't it? That is the face you make when you see your life savings take a nosedive. It's that gut-wrenching feeling that our source calls the behavioral pain point. It's that exact moment when your long-term plan goes right out the window because of pure, raw panic.
And all of this brings us to a fundamental dilemma that every single investor faces. It's this constant tug of war, this trade-off between wanting something simple and easy and needing something that's genuinely safe when markets get really, really ugly. So let's just lay it all out. The whole promise of a lazy portfolio is that it's simple, static, and safe for the long haul. But the reality, at least according to this analysis, is that you lag when times are good and you still crash hard when times are bad, creating this huge risk that you'll just bail at the worst possible time. It's kind of the exact opposite of what you signed up for.
So that leaves us with this massive, hanging question. If the so-called lazy approach isn't the fortress we thought it was, then what is? What does it actually take to build a portfolio that can withstand a true market storm? And maybe even more important, what does it take to build a strategy that helps you withstand the panic that comes along with it?